to trend and go towards the top, which we'll see and be able to address it. So again, that's slido.com. Code is EXPI, and we'll try to take all your questions in the time allotted today. So with that, Glenn, do you want to kick it off, or should we wait to hear from? Okay, it looks like the stream is live. So thank you for joining us. This is the EXP World Holdings shareholder Q&A session. With us today is Glenn Sanford, Chairman, CEO, and founder of EXP World Holdings, who you all know, and Jeff Whiteside as well, CFO and Chief Collaboration Officer. I think I'll kick it off right with the first question, and something that's on everyone's mind, about the stock price, and the way it's traded, and when you'll see the stock bouncing back, and maybe some insight on the up and down movement. I know this is something that, Glenn, you were able to address yesterday in your prepared comments, but maybe to you to kick off that first question.
Yeah, well, obviously the stock has definitely made a run up earlier this year. Earlier in the year, we ended up actually after the stock split, I think we went to $90 a share, sort of post split. We had actually been talking about doing the stock split when the stock was going over around 60, which actually on a post-split basis, we're pretty close to that same price at the moment. And then obviously we got that announced. A lot of times stocks do run in anticipation of stock splits, so there tends to be a little bit of pent-up buying that ends up coming in. And then historically, for a lot of companies, once the stock splits, when people have twice as many shares, or in some cases 3 or 4 times as many shares, depending on the company that's splitting the stock, a lot of times people will sell off a certain number of shares and reduce their shareholding. So it tends to be a little volatile around the times of stock splits, and that's just that's across lots of companies, not just EXP. We ended up in a situation where, in addition to having had a monster run up in the stock value, and I think a lot of that had to do with the fact that the company had built up, not the company, but there was a built up short position in the stock that had got fairly substantial. And when a stock goes up, a lot of times, margin calls and other things kick in, and those who are short end up having to cover, and that can create, to some extent, a higher than normal spike in the price of a stock, and so there tends to be more volatility, especially when you think about a company like EXP, where 60 to 70% of the shares are relatively closely held. And when I say that, they're held by insiders, like myself and others who have been long-term shareholders since inception, our agents and brokers through our equity awards. And so you start to sort of figure all that out. And so a smaller number of shares trading can actually create more price fluctuations than in a company. And you can look at lots of companies where literally there's the amount of actual aligned ownership interest in the company is super, super small. I mean, in some cases, you'll see companies that are, 95, 98% owned by people who aren't running the company and have no long-term vested interests. And so those companies tend to be less volatile, but because they also have a less aligned interest, they may not actually be, they may not do as well as companies that have high founder ownership. And, you can look at companies like, EXP certainly has high founder ownership, and certainly not suggesting that we're the same types of companies, but you look at the companies that have grown the most, and the ones that are the most well revered companies, they all generally have high insider ownership. And you think about, the Apples, the Microsofts, the Googles, the Teslas, obviously those are tech companies and so on and so forth, but they all had high founder led ownership groups, and so with that, I think also creates a lot more alignment of interest with the long-term value of the company. So anyway, that's just a little bit of commentary. I mean, obviously the stocks had a nice bounce back. I think on Thursday or Friday, had a big run-up day. Yesterday was up a little bit. Today is up a little bit, and I think that has to do with the fact that a lot of tech companies, real estate companies had maybe overcorrected. And so now you have a bunch of these same companies that had went up quite a bit, come down quite a bit, and are now starting to move back up again. So anyway, that's a little bit of commentary around the stock.
And Greg, I would add that we're very long-term focused, and really very proud of the results quarter after quarter after quarter. So I went through that yesterday, the 2018 all through the first quarter of 2021, and the company's in fantastic financial shape. As Glenn said, it was a massive run up, but a year ago the stock was $4.62. Today it's $28.20. So it's gone up 5 times in the last 12 months. So we can't control how it goes up and down, as Glenn said, but what we do control is how we do, and we're, as you can see from the financial results, all the way through Q1 of 2021, we're doing very well and positioned for a great stretch of growth.
Yeah, you might even noted just one last. It's a little data point, but you might have noticed that last week, I think on Friday, if I'm not mistaken, or maybe it's Thursday, I took an opportunity to actually take down some options that I had since 2012, and I took those down, so that should give you at least some indication where I think the value is, because there's tax consequences based on when you take it down, and then what the stock does after that. Obviously, we can't predict what the stock's going to do, and I may end up somewhat regretting taking them down at that point in time, which we won't know for 3-6 till actually my tax bill next year. But it was I think I took 1.5 million shares down from an option I had back from 2012, and I did that last week just to give you some sense of where my head's at.
That's a great point and a huge vote of confidence, I think, from leadership. At the end of the day, you guys have really driven quite a lot of value, and I know a lot of people are concerned about these near-term fluctuations, but you've done an amazing job of driving that growth, and overall the trend has been very positive. So a question we're getting a lot, and just to address it, I know that there's a vote to increase the authorization and the amount of shares outstanding. Can you maybe describe why we're doing that a little bit? And you might have touched on this a little bit. And then just further to that point, are you planning to do another stock split?
I think at some point there's likely another stock split. And the reason why I say that is that we think that we're gonna and it may not be for a year or two. It's not like we're saying that's going to happen anytime soon, but assuming that we deliver on all the things that we've talked about in terms of growing the agent base over the next year to generally speaking, we'll just say 100,000 agents in the next 5 years. Let's say that we can get that to 500,000 agents across worldwide, which I don't think is an unreasonable potential. It's a stretch. I'm not saying it's going to be easy or that we're going to get there, but we're definitely going to be tracking that direction over the next 5 years. But let's say that we do, track that direction, then in theory, assuming the company's more profitable and we've got affiliate services kicking in, all the other things that will sort of create, a valuation metric that would tick the value up. If the stock gets to $100 a share at some point, again, I would fully expect that we would think about a stock split. But again, it might not be for a few years, and we don't know what's going to happen in the economy for the next little bit. We know that we've built a model that last year, in March, April, May, when the housing market basically took a super pause, we had our most profitable quarter ever, and that's because we built a very strong variable cost structure to run the brokerage. So we're able to, for all intents and purposes, be profitable in good times and bad times, and that's a general statement. I'm sure there's situations where we would technically, have losses, but I think the current economy, anything that's being thrown at us, anything that we're seeing, we think that we can continue to build something long-term, sustainable, and profitable. So, that should, in theory, mean that if we continue to grow it, that the stock should be higher, and a stock split then would make sense.
Okay, perfect.
And Greg, I think it is important because back in the day, there was a lot of concern about dilution of the stock, and I want to make sure that everybody's clear. When we do a stock split, it does not dilute the stock. There is no dilution in the split. All right, so you're just getting a 2-for-1 share, whatever happens to be. So there is no dilution from splitting the stock. Number one. But number two, we put a stock buyback in process. We're in year 3 right now, and actually, as the stock has kind of come back to where it is right now, we increased that by 50%. So last year we spent about $30 million buying back stock, and our plan, the strategy here, is to offset the dilution from the agent awards, and that's a big part of our model. And we understand that we're never going to stop that, but we want to offset that from a dilution standpoint. And going into this quarter, when we look at this kind of to back up more of Glenn's confidence in the stock, we increased that buyback to 50%. So we're on track to buy back over $20 million this month. So that's how confident we are in the stock, and also that's how focused we are in preventing dilution going forward.
Wow. Okay. So you guys have really accelerated that plan. That's great to see. Last question, I think, on stock related stuff. There's some questions related to the business, which I'll get to. Someone has asked, is there a way for agents and brokers to actually buy EXP shares in addition to the 5% contribution from their commission if they choose to do so? Maybe a good opportunity to rehash this.
Yeah, I mean, so one of the things that we did early on, and this was really key. So we reserved almost all of the equity benefits to active agents who are actively listing and selling real estate, and that was by design. We did that because we wanted to create a benefit that was specifically tied to sales, and so we introduced, obviously, first transaction, capping. We do have one agent attraction, one-time award for attracting an agent, but then there's an icon agent award, and then you have the opportunity to get stock in lieu of 5% of your commissions at a 10% discount to market. So those are all designed for agents based on production. The other piece of it is obviously, we're, as a public company, you can go and open up your TD Ameritrade, your Schwab, your Robinhood, your whatever, and you can buy and sell as much stock as you want to do. So if you see an opportunity and there's, we'll just say, if there's weakness in the stock and you perceive it as an agent, maybe it's a good opportunity to just go into your account and buy some shares. Obviously, if the stock goes up a fair bit, you may want to sell some shares, and that's the beauty of having an active market for the stock. We were the first company in the history of real estate to actually provide an equity benefit for our agents and brokers, and that was actually liquid, that you could actually go into the open market and sell. And now we've got a bunch of companies copying that model because it was so powerful. But there's only so much stock that we can provide sort of at a discount in order to make sure that we run the company and steward in a way that makes sense. So we'll likely always have a ability to get stock at a discount based on selling real estate. But the alternative is that you have the opportunity to go and take advantage of just understanding the business, understanding the company, and then trading for your own account in a third-party brokerage account.
Okay, great. And, maybe, kind of thinking about the competitive landscape, one of the questions we have here, Glenn and Jeff, is, you think about the residential real estate brokerage industry. It's highly competitive. Tech-enabled brokers are rolling out. The question is, how does EXP fit within that competitive landscape today with traditional shops like a Keller Williams, and then tech-focused companies like Redfin, as they call it, and even some of the smaller ones like Fathom? Maybe if you could just comment generally on some of the differences and where EXP stands out.
Yeah, I mean, those particular ones, we are well positioned against all of those. So I'll talk to each one of them, what I think the strengths and weaknesses are of each of them. Obviously, they're going to believe differently because they're their companies. But from my perspective, Keller Williams fits into a broader category of franchise-based real estate brokerages. And so you can think about Keller Williams, Remax, Coldwell Banker, all the Realty brands, Berkshire Hathaway, all of these are franchise systems that basically sell franchises. So because the parent company can't afford to put the physical bricks and mortar in place to actually run those brokerages and be profitable. The amount of money, if you think about, just take 600 offices, which would be a typical reasonably large franchise, and you take that times some number, let's just say, $200,000 a year to keep those offices open. That's a lot of infrastructure that's being paid for by a local franchisee, and that's really the benefit of a franchisee. The negative is that these franchise agreements have typically an average of 5 years, 7 years, 10 years on their franchise when you actually sign your franchise agreement, and it locks you in as a franchise owner into what you can and can't do. You can't get rid of your physical offices. That's typically against the franchise agreement. You typically can't have more than so many offices personally if you aren't in the, say, top 25% of franchisees. So there's a bunch of rules around it that just hurts. I wouldn't want to be in the residential real estate brokerage franchise business, because I think it's just going to be a painful business. Redfin, a great company in that they've figured out how to use their website to generate leads for their agents, but that's also their Achilles heel. They actually don't employ agents that manage their own databases. So as a result, the business is somewhat limited by Redfin's ability to market, which is why you see so much advertising online and on TV advertising Redfin. And it has to do with the fact that they are very much of a dependent, the agents are 100% dependent on the leads and the effectiveness of Redfin's ability to generate leads in the various marketplaces. And then they had to scale up and scale down their workforce, because all of their workforce are employees. And so that makes it kind of tough. So 2 years ago, I think 2020, maybe 2019, we actually passed Redfin in terms of sales volume, and certainly we passed Redfin on a profitability basis, because they actually run a very expensive firm. Fathom's an interesting one. They're a more akin to a HomeSmart or Realty One group with a little bit of token equity, but not enough to really change the game that much. So it's a neat model. They're growing. They're what, 4,000 or 5,000 agents. I don't know what their exact numbers are, but they haven't created a model that really incents agents to really take the growing of the brokerage to the next level. So it's a great brokerage for the type of brokerage that it is. It's in a totally different category than EXP is. certainly, we can't talk about all these companies, at least not touch on Real. Real basically, if you think about a sort of more of a copycat type of model, they literally rev share equity. They reverse. Literally the whole thing is kind of a copy of the EXP model. So I don't know if there's a whole bunch of innovation there, but it's an interesting one in that they've sort of said, well, if you like EXP, you're going to like Real, and that's kind of their whole sales pitch. So anyway, those are the ones I've touched on. Any more?
Yeah, there is actually two big ones. One is leadership. All right, I've been with Glenn for almost 3 years now, and seen the leadership in the industry, and I think we by far have the best leadership, which is huge in businesses. And number two, the platform that we work on, Verbella, gives us productivity, speed, and just growth like you wouldn't believe. I'm in the international Greet Meet today. There's 16 countries in there with people from 16 countries. And we did that pretty much within a year based on this platform and the leadership we have in the company. So from a scale standpoint, our model, between the model itself and the technology that we work on, I believe they're very, very large competitive advantages.
Awesome.
Yeah, no, that's great. And I guess looking at, more on the operations and kind of turning towards the acquisition front, we have two questions on some of the recent acquisitions. First being Success. We know that was a big acquisition for the company. The question there is, where are agents likely to benefit the most from that acquisition? And then the next is, I'll just lump these together, the Showcase IDX acquisition. So, do you see that platform competing in a few years with search giants like Zillow, for instance?
Yeah, so the Success was, it's a really interesting acquisition for sure. It was one of those ones that we were, again, similar to Verbella, we were the largest single customer of Success, which made it quite interesting in that we were the largest, mailing it out to 40-something thousand agents at the time when we bought it, or maybe 39,000. And then we were offered the opportunity to buy Success. And by the way, when we bought Success, you think about success.com and all the stuff that it has behind it, we bought the entire company for right at $8 million. And you think about that, that's, success.com by itself as a domain name, even if there was nothing there, would probably be worth, $8 million by itself. You attach the 125-year-old brand to it, the personal development space. The magazine's been around for 125 years, and you start to think about the fact that real estate professionals or anybody in sales, it's a personal development game that we monetize through the sales profession, and so when you think about the longest running personal development business. And having that inside the ecosystem, it really allows us to start to build out some of those coaching assets, provide different outlets for training. But then, we talked about yesterday, Success Space, and I think, for those agents or brokers or folks that want to have some sort of physical space that's not a real estate brokerage, because EXP is a pure play, a cloud play, and there are some agents that do have their own offices for their teams, et cetera. But if they want to have something where maybe they do run into prospective buyers or sellers, and just from a different business perspective, the Success Co-work franchise, I think, is going to be a big hit over the long haul. And we got, I think we're just now at 6 months owning Success, and we're just now starting to get some of the things that we've invested in over the last 6 months start to show up. So the coaching, the Success Achievers community, the co-work. We've got an app coming out in the App Store here, the Success Achievers achievement system, which effectively is the way that we that we run EXP. We run it with a very agile process. So a lot of cool stuff. On Showcase, Showcase, I'm excited about the idea that we can actually control our destiny online. We can build out all the assets that would allow us to actually compete with Zillow, Redfin, Realtor.com, HomeSnap, Movado, any of those big players will be able to actually have a site that eventually will have traction. So excited about what that is. It's still, we're not even 8 months, 9 months into owning a Showcase, but they're definitely doing a lot of work behind the scenes. There's a lot of plumbing that has to be put in place so that we can then really deploy a really cool platform, which we'll see a lot of the iterations show up in the second half of the year. So right now you've got kind of a framework for a search site, but in the later part of the year, you're going to see some of the investments there start to take shape as well.
Okay, great. And Jeff, this is probably a good question for you, and maybe Glenn, you want to jump in just on the growth rates in the business. I mean, the U.S. growth rate. Your growth rate in general has been just off the charts, specifically in the U.S., which I know is driving a lot of the agents coming on board to EXP, and therefore a lot of the revenues and other great things we're doing. So the question is, are you seeing pretty significant differences in trends in growth rates in different markets? So Europe versus India versus Mexico, for example.
Yeah, I can answer that. What we are seeing, if you look at last year, our growth rate was really strong, especially considering a 33% growth rate in Q3 with COVID. So we picked up after that. We're seeing in Q1, the numbers that we saw was an incredible Q1 number, and primarily based on the U.S. Growth rate. And as far as I'm concerned, as an investor or looking at this company, our biggest piece of our revenue is still coming from the U.S. as we launch commercial, as we launch international, and they added over a gross 11,000 agents in Q1 alone. Right, so I think it's kind of early days. We're seeing some good traction in countries like Mexico. We're seeing countries like India. Talking to Adam Day earlier today in the UK. They've struggled a little bit with the lockdowns and things like that, but things are starting to come. They're starting to come out of that right now as we speak. So I think that we see the growth. I think we kind of. I looked at, within 12 months or so, we can see about 20% of our agents internationally, and then it growing from there. So we're launching primarily in these new countries right now, but at the same time, the U.S. is just doing fantastic.
Great. Very, very helpful. Here's a question. How would you explain express offers in comparison to the other big iBuyers, such as Opendoor and Zillow?
Well, the big one is that when you think about Zillow, Opendoor, etc., those are very balance sheet intensive for those companies. And what I basically mean by that is that Zillow is actually buying the house, Opendoor is actually buying the house, then they're doing the repairs, and then they're remarketing the house. And as long as the market is going up, which obviously it has been, so there's been very little risk for them to buy properties and to put them on their balance sheet. What we did see last year was that when COVID hit, everybody quit buying homes, but express offers continued to make offers on homes. So because we were actually backed by actual investors who will put in bids on properties because they have an understanding of what the homes are worth to them. So they're a lot of times they're the end buyer. They might be buying for their rental portfolio. They might be doing a number of different things. So we've got hundreds of buyers all over the country that are bidding on properties in their particular buy boxes. So But more importantly, what Express Offers does is it provides a platform for agent lead gen. And so that gives agents an advantage in that they can be driving traffic to a lead capture that actually has investors making offers on properties. In all likelihood, 25 of them, 29 of them, some high percentage of them won't go with the iBuyer route, whether it doesn't matter whether it's Open Door, Zillow or Express Offers, but it does give that same agent an opportunity to go out there and list a home. And so if you think about it from we'll compare Zillow Flex to this. Zillow basically is using it, and then they're charging referral fees on all those leads that they don't buy. And that's actually how they make their money, is really on that. So they may not make a whole bunch on the iBuyer side, but they'll make money by charging a 30% referral fee. Well, agents that actually do that lead gen inside of EXP effectively get those leads almost for free. And I say that almost for free because they have to pay for the front end of the lead gen. There should be, in theory, enough of the iBuyer transactions that actually close to pay for the lead gen, and then any of the additional leads that come through that platform go to the agent at a relatively nominal cost to potentially convert into a full-on listing, put a sign in the ground, market, et cetera. And so that puts an agent at a significant advantage versus the third-party companies where they're at a significant disadvantage, because those companies, and I love, by the way, I love Shareholders, but when you make decisions that are primarily about making money, you sometimes hurt the customer you're trying to serve. In our case, that's our agents. And so we're always trying to innovate, develop new tools, technologies, and services that don't actually cost agents money, they actually make agents money. And that's the big difference.
Okay, great. Well, speaking of innovation, I want to get one of the big questions out of the way, and this has popped up a few times from people submitting questions. COVID kind of rocked the world. Obviously, that was great for EXP, and the growth was strong before, kind of through COVID, which is fantastic. The question is, as things open up, how does Verbella really stand out? And then, maybe two other segments from this, I'm piecing together some questions. Maybe if you could touch on, the differences between using Verbella or Zoom, where there could be a lot of fatigue, for instance, and then the cost savings that Verbella can offer.
Well, we refer to the Verbella and really the virtual world for business concept as the single enabling technology that allowed us to actually scale EXP as quickly and as collaboratively as we did. So if you think about, a company starting from scratch today, maybe you use Zoom, but Zoom fatigue is a phrase for a reason. Most people actually now hate being on Zoom. It's hard to stay, pay attention to the camera while there's a speaker, what have you. They're scheduled meetings versus stuff that's more serendipitous in terms of just regular, just run-ins to each other. Where the Verbella platform allows for, if I want to, catch up with Jeff, just use him for example, I may want to just catch up with him and bounce an idea off of him, but it's not a really germane idea yet. It's just something that's in the back of my mind. It's just something I just want somebody to brainstorm with. And because of, Jeff and my working relationship, I want to bounce it off of him. Well, because it's not high priority, I could wait till our scheduled stand-up, that we have a couple stand-ups every week, or I could just jump in World, see if Jeff's in his office, knock on his door, go, Jeff, you got a minute? And we could just have a quick little conversation around it. And it doesn't feel like I'm wasting his time with something that's fairly small at this point in time, but has the potential to get big. And you think about that's the value of physical bricks and mortar. It's the fact that, somebody might come up with an idea, or They might be able to, bounce something off of somebody, or they could go see somebody at the cafe or whatever. So that's really the big value out of bricks and mortar. But when you can reduce the single biggest cost to run a company, and at least in residential real estate, the single biggest cost is bricks and mortar, and you can eliminate that cost, and you can still keep the collaboration high, it's such a competitive advantage that, I'm still surprised that we're still one of the few companies of scale that's using a virtual world for business, because it provides so much benefit to us as a company.
Yeah, so obviously a bunch of benefits even outside of a environment where you can't be in an office together. So that's super helpful. I want to be mindful of time. I know the time allocated was to 12:15 Central, where I'm at. I guess the last question I'll put up here, and this always seems to kind of come to the surface, is can you explain NPS? Obviously, that's been on the rise, and why that's important.
Okay, awesome. I know we've got another call here that the three of us are actually supposed to start, I think, a minute ago. But Net Promoter Score, I'll give you guys a couple books to read. If you read them, you will get NPS. You'll understand why I think it's the most important metric that we measure at EXP. The Leader's Guide to Radical Management by Stephen Denning, and The Ultimate Question 2.0 by Fred Reichard, I think is his name. Read those two books. You'll come out with a tool that no matter what you do in whatever profession you're primarily in, it'll give you a tool that will allow you to out-innovate your competition by understanding your customer, by asking one simple question. On a scale of 0 to 10, how likely is it that you would refer a friend or colleague to join or work with eXp Realty? And then the second question that goes with that is, what most influenced you to give us that score? And those two questions combined give us all the data, not technically all the data, but 95 to 99% of the data that we need as a leadership team to make good decisions that deliver great value to our agents, brokers, and staff.
Awesome. Well, I think that's a great place to end. Obviously, we wish we could answer more questions. If you do have additional questions, feel free to submit them to Investor Relations. That's investors@expworldholdings.com. We'd be happy to try to answer them all for you in a timely fashion. But I think we do need to break here, and appreciate you all joining. Glenn, Jeff, awesome to have you, and thanks for all your time.
Awesome. Thanks, everyone.
Thank you very much. Appreciate it. Thank you very much. See you.
All right. Talk to you soon.
Hey, Jen, we ready to go?
Uploading the presentation now, and we are ready to rock and roll.
You are the best. I appreciate you.
Likewise.
Hey, Peter.
in. Texas seeing quite a bit. So there are markets where the data is definitely showing us patterns of where migration is moving out and where it's moving in. I really enjoyed this slide. I think it's a good one.
Yeah, I think this is a great one. And, the interesting thing about this from a market standpoint is that, what we're used to seeing is a lot of these cities are, as I referred to before, those canary in the coal mine, right? A lot of these big cities are the markets that saw things first, and they were the precursor to, what was to come in a lot of circumstances. So when you watch their inventory and watch the pricing and REOs and that sort of thing, it's a little bit different here because, although these are seeing a change and maybe they're seeing more inventory as people are migrating out, that's not necessarily the precursor for the entire economy because it's not a slowdown that is necessarily the same across the board because these people are moving other places.
Absolutely. That's why we're really getting back to the very regional picture of the health of housing markets. Another very distinct difference from 2008, right, where it was really a national problem. It's why much more akin to natural disasters that are more regional in their nature, and it's a very regional story. Next slide. So this just gets to the point you were making earlier, Dave, that buyers and tenants are preferring single family over multifamily, and suburban locations are hot, but the denser city center locations are not. And this is just showing, essentially showing how the home price data that we monitor tracks with the net migration in and out from the mortgage loan application data I was showing earlier. And clearly we could see, whether it's home ownership or rental, home prices or rent prices. Single family detached is seeing the biggest price increases, detached lower but still increasing, and we're seeing decreases in multifamily rental and ownership, which is what you would traditionally see in the urban core.
Yeah, and is that a factor of people moving out of those larger cities, which tend to have more of the multifamily, or is that also tied in with COVID, where people have tended to move towards, those areas have been more shut down and have less ability to get out and going. So we've seen people move out for that reason.
Well, both. But really, to your point, I mean, really the former is where we definitely feel like the data is validating what we've all been kind of intuiting, right? Which is that people really have been moving out of the urban cores into the suburbs, exurbs, other smaller cities, coastal cities, smaller coastal cities. There's been a kind of a shift in emphasis and priority from rental to home ownership. And that in of itself, when you get back to like what some of these things that are driving home price increases, it's lack of supply, right? I mean, there's we could spend a whole session, we won't do it here, of course, but whole session on the kind of lack of, I mean, really, when we talk about one of the biggest challenges to trying to slow the increase in house prices is we've got to get more supply into the system, particularly for entry buyers. By CoreLogic estimates and analysis I did, there's roughly 1.2 million under supply today, right? Sitting here today, we've got a 1.2 million under supply of entry units for homeowners who are between, or what should be homeowners who are between 50% of area median income, so earn half of what their neighbors earn, up to 120%, earn a little bit more than what their neighbors earn, area median income. So, a whole swath of folks that are kind of locked out of housing and home ownership because of just undersupply. We've got to solve that problem.
Yeah, that's a pretty long runway.
Yes.
Not something that'll be solved quickly. So, the multiple effects, we have the affordability issue with the driving up of costs of the home prices. Then we have the pandemic, which caused people to move into areas that maybe were less restrictive as a result. But also we had the work from home. And I think your next slide talks about that as well. So we have this kind of triple effect and impact on these major metro markets where we look at people moving for pricing, moving to move out of the restrictive areas, and then you have work from home, which became a new option where people no longer had to be in a spot where they needed to commute.
That's exactly right. And so, I know this is somewhat of a dense slide, my apologies, but, just trying to pull some empirical evidence that shows that, work from home is obviously a huge factor in 2020, continues to be in 2021, and there's an increasing building body of evidence that suggests that this is a trend that's not going away. Surveys and studies are showing that anywhere from 20 to 25% of workers will remain work from home, at least part or full time, for the long term. And this can have the effect of well, first of all, it might kind of it might cement in this pattern of migration from urban centers into suburbs, exurb smaller cities. Remains to be seen, but it may not. Another way one might look at it is that perhaps in the urban centers, folks feel more comfortable returning to them if we start to approach herd immunity, and that actually can end up being a tailwind on the supply issue. Right, where if we've got commercial space that's no longer relevant in urban cores, that is now capacity and land availability that can be redeployed for residential. And
right.
Depending on preferences, if preferences are not in favor of multifamily home ownership, that'll be a problem. But price also matters a lot. So given where home prices are heading, I could imagine that there's a trend that could reverse.
Sure. Yeah, we saw the repurposing of warehousing, right, in the last several decades. We've seen some of the revival of cities like Pittsburgh and some others where, they've repurposed that commercial space, and it's really created a boom as there's been an influx. And I think that we have the opportunity to see a shift in the demographic makeup of the cities. I think we're going to see, different folks moving out and different folks moving in, and I think it's going to be really interesting to watch how both cities and the more rural areas change as there's a shift in who typically lives there and maybe now who is living there over the next decade or so.
Love it. Totally agree. Next slide, please. Oh, thank you. You're there. Sorry. You beat me to the punch. So just, this just really quick, I'd touch on that, we talk about purchase, but, to the extent home equity is a focus, we are seeing tremendous activity in the home equity space. Home equity loans, lines of credit, a record $337 billion was spent in 2020 on home improvements. This would relate to this kind of work from home dynamic. Expected to grow 5%, Q1 2021 into Q1 2022. This chart just shows where we can see kind of the average equity per home. Next slide. And just a little bit more on this, you could see, just the kind of trending on homeowner improvements and repairs. For a long time, we saw muted home equity loan volumes, but this is growing now. And, the U.S. average home equity per borrower, kind of astounding, $200,000. I mean, that's really, quite a bit of equity. Next slide.
Now, on the equity real quick, I read also that more homeowners have been putting money into paying down their mortgages, right? We've seen a little bit different in the savings and spending, and that's been a little bit of the impact, and maybe it's because people couldn't spend money on going on vacation, but there's been a trend in that as well. So the increase in equity just from the home price increasing, but also trends in paying towards property, and also trends in the mindset. And this is also something we saw with the millennials and some others, where they put more emphasis on putting money into their mortgage and paying down their mortgage than paying down other debt.
Yes, that is absolutely right. Absolutely right. Our data would agree with that. So just to cap this off, there's a lot of slides here. We don't need to go through all of them, but this just gets the kind of the caveat, the big but I managed earlier, right? Which is that, we talked about how all these different factors, like, where's inflation, where are interest rates, what's going to happen with unemployment. These are huge factors in determining the health of credit availability, the ability, which by extension will impact purchase volumes. But we've got to remember this forbearance activity, right? That we are standing here, and the net of it, because I know we're almost out of time. If I were to really kind of focus on the most important, I'll skip some of these slides. These slides are just basically indicating that We've seen a huge spike in serious delinquencies. Thanks to the CARES Act, a lot of borrowers have been able to bide their time, pause their payments without penalty, without effect to their credit histories. That's been huge. But we're coming to the reckoning, right? Where the CFPB recently put in place a foreclosure moratorium to the end of the year. I think, practically speaking, I don't think that's having much of an effect. I know industry has been unhappy about it, but personally, I don't think it really matters. I think that the important issue here is that, and actually, if anything, I might even argue it's a good thing, because we're going to see roughly 2.5 million borrowers exit forbearance late summer, early fall. And these borrowers are disproportionately FHA borrowers who are disproportionately low to moderate income. So what we do not want to see is, while we do have tremendous amounts, if I could maybe ask you go forward a slide or two. One more maybe. Yeah, there we go. I mean, on the one hand, there's a lot of home equity, right? And there's an argument, a line of argument that says, this isn't that big a deal. Borrowers come out of CARES Act forbearance. They've got all this home equity. It's not like the financial crisis of 2008 where we had tons of negative equity. Worst case scenario, the homeowner just sells the home. Well, that sounds to me like one of these things where it works until it doesn't, right? Like, imagine 2 million, 2.5 million homeowners. It wouldn't be that bad, that severe, of course, but imagine like some large subset of number exiting forbearance, going into loss mitigation, trying a loan modification or a payment deferral, but they don't have their employment back yet. They go into default. Now, all of a sudden, we're seeing a wave of homes flooding the market. Our supply problem could really reverse itself quite instantly, right? If all of a sudden these 2.5 million homeowners start flooding the market with listings, right? So it's just to say that, well, it's good for sure that we have home equity in the system now, and that gives borrowers more options. It doesn't do the market much good if all of a sudden the market's flooded, particularly with lower priced homes. All at once, right? We don't want to see that happen either.
Well, and that damages the equity that those folks have that they're counting on to be able to sell and move to their next home to get out of their current situation, right? So that takes away from their opportunity. If it has too much of a downward impact on prices, that will eventually could be a snowball effect.
And that's the bottom line, Dave, that it's like, what is that inflection point where if too many homes flood the market at once, we see this home price increase stop, reverse, and start going in the opposite direction. And I'll end on just two slides ahead. Yeah, that one there. It's like, we're seeing it, the U.S. negative equity share, it's only 2.8%. So it is quite low. But you can see that, again, this is a regional story. There are states that have been particularly hit hard by COVID, just for various reasons. That some that are on the brink that have low, negative equity, very high. But it's just, this is something we have to watch, because this will be another canary in the coal mine. If we start to see negative equity shares shift up, that's a real bad sign. And stop there. Unless you have any other, sorry, David, any other remarks you have, of course.
This graph I think is an important one, and it's interesting to see how it's in some ways similar to what we saw before, but there's some differences, right? As far as some of the states that were prominent in the past, and then that are prominent happening here. Is this just a factor of the discussion that we've been having to date, so far today, as far as why we're seeing some differences, or?
It's a mix of differences. I mean, so some of it predates the COVID crisis. Some of it's made worse by the COVID crisis, but all of it has been muted by by all of the kind of macro and microeconomic conditions that have kept home prices not only stable, but marching upward. So it is a very complex, nuanced story that is going to be a state-by-state regional kind of story. And, without an easy, obvious answer to it, it gets down to, really kind of nuanced macro and microeconomic dynamics going on in each of these regions. As we got to keep tabs on moving forward.
Great. All right, Peter. Well, hey, appreciate you. I appreciate all this information is so useful, and knowledge is power. And speaking to our agents and anyone who's looking at, if they're investing in real estate, they're looking at serving their clients to the highest level. And we talk to our agents about, going to where the opportunity is, understanding what that looks like. These are the numbers and factors that we need to be plugged into and to be engaged with to get an understanding of both, how to provide good data to our clients to understand their circumstance, to prepare ourselves for the market of the moment of what might be ahead, and what the long term looks like. So, this is great information. We will have these slides available for everyone so that you guys can continue to look at these and digest them and do your own research. And we'll be doing more and more classes on this and how to prepare your businesses to compete and to serve at a high level. So Pete, thanks again for being here. We really appreciate this.
Thanks, Dave. I enjoyed it greatly, and thank you, everyone. Really enjoyed being here.
Likewise. Thanks all.
Now off I'm walking off stage.
Don't trip on the way down.
Oh, and I don't just click.
You bet.
Okay. Hello, everyone. My name is Philip Hu. I'm a CEO and president for Trans Global. We are actually close to 200 full-time staff company with all the investment, tax service, real estate. I'm also part of the EXPI family, and also mortgage and insurance. Now, today I'd like to talk about a concept that maybe blow your mind away, and regarding it's not only how much your money you can make, it's mainly how much money you can keep. And most of the people try hard to make money, but they don't know how to save tax. That's one of the things I want to share with everybody. Some of you can also zoom in on the screen. We can share you the topic today. Now, today I have 4 different topics. I quickly go over the 4 different topics. 4 different topics. The PowerPoint don't move. Okay. Now, the first one I want to share with everybody is why we even need a tax coach. A lot of time, this concept probably a lot of people don't realize. What is a tax coach and why we need it? Second, as a realtors, how can we maximize our tax saving? Now, and also how can we help our business owner clients? How can we help them? The most important thing is Biden tax proposal. Who will get hurt? And how should we deal with this? How should we deal with it? That's the topics I want to share with everybody. Okay. Next page. Okay. Now, this is a statement I want to make here. So everybody need to pay attention to what I just want to say now. If you are self-employees, receive a 1099 income, no matter real estate agent, loan agent, contractor, if you make over $80,000 net income, if you make over $80,000 in net 1099 income, you might, and most likely you are, overpaying $5,000 to $15,000 in income tax every single year. Like our team of tax coaches can help you stop overpaying your tax so you can keep your hard-earned money year after year. We can help you never overpaying your tax anymore. Never overpaying tax anymore. Now, more, okay. Now, what is a coach team? Okay, why we need one? Why we need even one? Now, a lot of time there's 2 things we don't understand. One is medical field. One is taxes. Oh, there's 2 things that majority of people are not familiar with. Let me use an example. If you go do a physical exam, do the lab test. And after lab test, 1 or 2 weeks later, your doctor office is going to call you. Okay, we have your lab report come out. They can talk about it. Will the doctor spend 1 to 2 hours with you to go over every single of your lab report? No, they're going to spend maybe 5 minutes, 10 minutes max. They will tell you, oh, everything looks fine, except your cholesterol is high and the blood pressure a little high. So you're kind of nervous. They said, what can you do? What can I do? The doctor said, okay, maybe you take some medicine. So you take cholesterol medicine, high blood pressure medicine. Is that the best solution for you? Typically not. Typically not. So that's why when we talk about it, we say, how about let's put it this way? In Asia, certain countries, especially like Taiwan, they have a physical exam center. One day you finish every single test. At the end of the test, a doctor will spend 1/2 hour to 2 hours, 2 hours time with you to go over every single step with you and explain to you each numbers. What does that mean? What does that do to you? Okay. Now, when they talk about cholesterol a little high, blood pressure a little high, they say, okay, there's a different options. You can improve your diet, you can exercise, maybe taking a prescription is a last resource. So after the result come out, after the consultation, after the holding hand, you know exactly what happened. Now, same thing, but in US, we don't have a service like that. If we have a service like that, it's much better that way. Same thing when we talk about taxes. Now, everybody focus on busy to make money, do your best. But when you talk about taxes, you always rely on your tax accountant, your CPA. So every year after you're doing this, tax season, you submit all your things to your CPA or tax accountant. And tax accountant will spend maybe 5 to 10 minutes with you. Oh, this year you need to pay $60,000 tax. And you say, how much? That much? What can I do? The tax accountant or CPA will tell you, okay, go open an IRA or go open a SEP. Is that the best choice for you? Do you have any other idea how many other different ways to help you to save tax? That's why we need the tax coach. The tax coach can guide you through, hold your hand, make sure you understand it, and also give you a different solution other than just some retirement plan. So today I want to give you a little quick lessons, give you a little understanding what happened to the taxes and what you need to do. First, let me share with everybody, there's a 3 type of income. When we talk about taxes, there's a 3 different type of income. The first one we call earned income. Earned income is you use yourself to make money. Salary, bonus, commission, they all consider earned income. The second one is passive income. What is a passive income? Is you don't have to do it yourself. Your investment, your property can help you make money. So that's why it's a passive income. The difference between earned income and passive income is also the federal level and the state level the same. The major differences is earned income, you have to pay self-employment tax. Or sometimes people say payroll tax. The last one is a capital gain. Capital gain, you have to sell your property in order to make money. That's a capital gain. We have a long-term capital gain and we have a short-term capital gain. Now, when we talk about taxes, there's also different taxes. We're going to talk about self-employment tax. We talk about federal income tax. We talk about long-term capital gain tax. And if you're making over $250,000, any passive income, you have another net investment tax. It's a 3.8%. We can talk about it. So let's give a little lesson on this one. Self-employment tax, payroll tax, it's total 15.3%. But do I pay 15.3% for all amount? No. We pay in 2021. You pay in 2021. You pay up to $142,800 for 15.3. Anything over that, your Social Security max out because of 15.3%. 12.4 is Social Security. 2.9%. 2.9% is Medicare. Okay, so this is a self-payroll tax. The second one is a federal tax, income tax, ordinary income. Then long-term capital gain, maximum is 20%. And net investment risk, net investment income. What is that for? It's for healthcare, Obamacare. That's why you need to pay 3.8%. Okay. Then we have state income tax in California. That's the worst one. Probably one that you pay up to 13.3%. Anyway, so if a gentleman make 300,000, if a person make 300,000, out of the 300,000, first 100,000 is a salary. Second 100,000 is rental income. Third 100,000 is a long-term capital gain. Now let's take a look. Do they pay tax separately? The first 100,000, because it's a salary, it's earned income, I have to pay 15.3% self-employment tax plus federal income tax plus state income tax. But the second 100,000 is a dividend or rental income, so I don't have to pay self-employment tax. I only need to pay federal and state. The third 100,000 is a long-term capital gain. When I sell the property, then I only need to pay long-term capital gain and state. This is a different tax, so everybody need to understand that. Now, let's say a realtor, okay, someone like you, okay, now, or people like us, making 150,000 after deduction, after all the expenses. So he makes $150,000 Schedule C income, just $150,000 net income. The CPA tell them, oh, you need to pay $49,000 tax. But most of us don't realize that out of the $49,000 tax, you pay $21,000 on payroll tax. Your federal tax is only $1,800. In California, if you're in California, you pay $9,500. So you pay total $49,000. The biggest tax you pay is self-employment tax, which is payroll tax. Okay? You don't pay that much income tax, $18,000, but still a lot. So the first thing you want to say, hey, what can I do? And then the CPA said, okay, or tax accountant said, go open the IRA. You spend $6,000, open the IRA account. When you open the IRA account, $6,000 IRA account, it helps you save you some of the federal tax and state. But your payroll tax still the same, which means your IRA is still subject to payroll tax. So you spend $6,000 open the IRA, your total tax saving from $49,000 drop to 47 something. Your total saving is only $1,700 when you save $6,000 IRA. Now people want to say more. So now people say, now can I open the SEP account? How much you can open save? Maximum SEP account based on $150,000 income is about $30,000. You put $30,000 in your SEP retirement account. Guess what? Your payroll tax still $21,000. Your payroll tax still $1,000. You only save federal and state tax. Federal and state tax. So your total tax saving when you spend $30,000 open a retirement SEP retirement account, your total tax saving is $7,800. Is that a lot? It's okay. So typically, most of the people, either you have no plan, pay $49,000, or open the IRA, save $1,700, or open the SEP, you can save $30,000 SEP, you save $7,000 something. But our job, our tax coaching team said, you can do better than that. You can do better than that. First, how about you just don't open any retirement plan. Just incorporate it. Make an S corporation. Make an X corporation. Now, out of S corporation, you split your income $150,000 to $60,000 salary plus $90,000 dividend, K1 income. Why I want to do that? Because IRS said for that level of income, you can put like 40 to 50% on salary, and the rest you can use as a dividend, corporation dividend. The reason why I do that is when I use a $60,000 salary, $90,000 K1, guess what? My payroll tax from $21,000, I can drop to less than $10,000. Even I need to pay a little bit more corporation expenses, but my total tax saving just when I incorporate it, I can save almost $7,000, equivalent to I set up a $30,000 SEP. I save the same tax, almost the same tax, without invest money on my retirement account. Somebody say, I already spent most of my money. I don't have money to do a retirement plan, but set up a corporation and do the right structure. You can save the same tax. Now, people say, I have money for a retirement plan. Now, can I open it more? Yes, we can help you to save a profit sharing 401k. We call solo 401k. It's a company set up a 401k plan. Instead of putting $30,000 into SEP, I can put a $34,500 maximum. So I can put $4,500 more than the SEP. But take a look. I can save $17,000 instead of $7,000. To open a $30,000 SEP, I save $7,000 something. But doing private solo 401k plan, with just putting $4,500 more, but I saved $10,000 more in tax. So I dropped my total tax liability from $49,000 down to $31,000. My average tax rate from 33% dropped to 21%. But if I'm over 50 years old, I can set up different type of retirement plan and put more money into 401k plan. I can put $60,000 into my retirement plan plus $26,000 401k. If I'm over 50 years old and taking $60,000 salary, I can save total $32,000 tax now. So instead of paying $49,000, now my tax liability is only less than $17,000. My average tax rate from 33% drop all the way until $11,000. Let's summarize a little bit. All the 6 different choices. The same income. The first one, no plan, $49,000. Second, open the IRA, $47,000. I need to pay. Open the $30,000 SEP, $41,000. This is a solution for majority of the people out there. This is the concept you can get. But by us to helping you set up a proper structure like incorporated, but a lot of time people go ask their CPA, tax accountant, said, do I need to open a corporation? The CPA said, no, you probably don't save much tax and expense is higher. They didn't know, or they didn't want to say is you save more self-employment tax than other tax. And if you want to save more, you can add something on top of it. Then if you only incorporate it, you can do $42,000. And if you open a solo 401k, you can do $31,000. And if you over 50, you have a chance to do $16,000. This is the solution people don't have. That's the one we want to share to everybody. That's why you need a tax coach and guide you through every single step. How can we help you to save tax? That is the reason why. Not only, that's why people need tax coach to guide you through. Now, another example, we want to share tax concept we want to share with everybody. Means not that's all income subject to taxation. I want to give everybody a little quick tax concept. A lot of time people selling real estate, if you don't use this concept, you miss the boat. Because most of the time people selling real estate because most of the realtors selling real estate because try to compare with a return. But actually, when the people tell you, say, hey, I like to invest stocks, but I don't like to invest in real estate because stock market average give people better return than real estate. I would say, if you don't put tax into consideration It is true because the average stock market perform better than real estate. But if you add leverage and all the tax benefit from the real estate can do a lot better than the stock market. I convince so many people, instead of doing more stock investment, they do more real estate investment. The reason why is the concept is because most of the stock, when you invest in the stock market, most of the income you are taxable. But when you invest in real estate, a lot of income can be non-taxable. So we need to focus on more non-taxable income. What is a non-taxable income? Means all the income you receive, not receive, do I have to pay tax? Let's say you buy a stock, okay? Whether you pay 10,000, you now go to 20,000. Now, when you sell it, you have to pay tax on it. If you don't sell it, dividend, you have to pay tax. In the real estate, how do you make money? When you buy real estate, you have two ways to make money. One is a rental income. One is appreciation. But what is the difference between real estate and stock market? Let's say I invest I collect $200,000 in the rental income. I have a rental property and collect $200,000 rent income. This $200,000 is my income, but is the $200,000 all taxable? The answer is no if you structure properly. How do we do that? $200,000. If a $200,000, there's a four major deduction from the rent income. Number one, all mortgage interest for income property is 100% tax deductible. There's no $750,000 limitation deduction. Number two, all property tax is 100% deductible. No $10,000 cap. So all mortgage interest, property tax, all 100% deductible. Number three, for income property, we have a depreciation. When you invest in stocks, there's no depreciation. The beauty for depreciation, you can pocket the earning, but you don't have to pay tax. It's just a paper loss plus maintenance. So let's say I collect $200,000, I pay $50,000 mortgage interest, I pay $50,000 property tax, I get $80,000 depreciation, I get $20,000 maintenance deduction. So out of $200,000 minus all this, my actual, if I design properly, my rental income can be zero. But stock income, I have to pay tax. Number two, all the appreciation, when I sell it, if I don't pay tax, I can use a 1031 exchange. And 1031 exchange, I can exchange for the rest of my life. Every time I sell it, I exchange it. So theoretically, I never have to pay income tax for the rest of my life if I structure properly. So that's why, and when I need the money, this is a newer concept. If in my property from 10,000, 100,000, 1 million go to 10 million, if I need the money, instead of selling the property and pay tax for it, can I borrow against it? I can borrow $6 million, $7 million, income tax free because it's a loan. Use a loan to get your money out. Use a rent to pay for my mortgage interest. I can enjoy all the equity, income tax free. Let my rent income pay for my mortgage interest. Theoretically, if I structure right, I can enjoy the growth and use the money and never pay income tax for the rest of my life. That is the reason why real estate is a lot better than stock market. So in the future, I suggest you, for every one of you, when you talk to a client, it's like, yeah, stock market maybe return is better than real estate for long run. But real estate, if you add leverage to increase the return, if you add their own return plus all the tax benefit, guess what? Real estate is a lot better than stock market, if you understand this. Now, so when if you run into business owner client, we can also show them all the different way they can save taxes. This is one of the business owner. This is one of the example how I can increase real estate sales, increase client to do refi to buy more property. Let me use an example. I run into a client, this successful business owner, making $1.2 million in his business. And also he has $100,000 rental income after expenses because he doesn't like to borrow too much and he didn't buy enough property. And he also trading stocks. He have $80,000 stock earning. But if this person in California, guess what? His federal tax, he need to pay $500,000, and his California state income tax is $137,000. So he make $1.3 million total out of $1.2 million from business and rental and stock, but close to $650,000 he need to pay tax. He need to pay tax. Half of them is gone. If he make more money, the situation even worse. So my suggestion to them is, do you know how much tax you need to pay for the $100,000 rental income? Then I show them, out of $100,000, if we change the rental income to zero, he can save $54,000, which I just proved to him. If you have $100,000 rental income with your tax bracket, you need to pay $54,000 income tax. Your net is only less than $46,000. What a terrible investment. Now, what can we do to help them for rental income drop to zero? I told them, go out, refinance, cash out, use the money cash out, buy more real estate so you can increase your mortgage interest payment. You can increase your property tax payment. You can increase your depreciation because you buy more property, income property. So we can change his rental income from $100,000 drop to zero and save him $54,000. Can you see that we create more sales because of this reason? And I also tell them, do you know your $80,000 stock investment, short-term capital gain, trading stock, looking good, but do you know how much tax you need to pay? Out of $80,000, you need to pay $43,000 income tax, more than 50%. So either they trade less of stock, buy more real estate, or use other different way, use their retirement, use other way to invest the stocks if they really like to invest stock. So we can deduct the capital gain from 43,000 down to zero. Just telling them, deduct, make a rental income go to zero, make their capital gain go to zero, the $180,000 become not taxable. I save him $96,000 tax. $96,000 tax. And after that, then we tell them, from your business, 1.2 million. There's more thing you can do. I can show you all the benefit. If you buy your own business property, then rent a property. Couple of weeks ago, I saw a couple of clients paying $800,000 on their rent for their business. I said, if you pay that kind of rent, you definitely should buy some more, buy property for your own business, because you save a lot more tax when you do compare with you rent the warehouse. For they listen to me, do the cash out, and go buy the properties. So we can help them to save the business, all the different way to help them the business saving money, invest on rental property, save taxes, invest stock market, how to structure properly in order to do that, how to increase their real estate portfolio, how to use other like life insurance to save taxes, all the situation. This is what we can do. Because if we don't help teach people how to save tax, because by the newly proposed tax increase will kill a lot more people, and kill a lot more market. That's why I want to share with us about things. By the newly proposed tax increase, how would that hurt the market? But if we do it right, even their tax rate increase, we don't get hurt as much. People need a more tax coach when the Biden increased tax. Now, why we need to increase tax? But everybody understand this. When this is our debt situation, we know we have more debt. There's our government. A lot of people don't know our government spending. 22.8% are spending in Social Security, 26% in Medicare, Medicaid, and other health program, 13% on all different type of welfare program. 7.9% paying government debt interest. And the rest, like defense budget and other budget. But I'm more concerned about people getting longer and longer, and more people collect Social Security, more people collect Medicare, and the most important thing, with such a low interest environment, we're still paying 7.9% of the tax revenue to pay interest. What happens if a government bond increase from 1% to 3%? And this portion will grow to 24%. And if people getting longer, live longer, our government spending going to continue to rise. That's the reason why we need to raise tax in the future, no matter what, unless we find a different way to make money. This is the way to make money. Now, the Biden income tax proposal, they keep telling them, oh, only people make over 400,000 will get hurt. People make more than $1 million will get hurt. It is true. One way is true, but you're going to hurt all the market. This is comparison. This is current tax law. But when you make over 400,000, instead of 32%, it jumped to 39.6 right away. So portion of people here, anything over here, it jumped from 32, 35, 37 to 39.6%. The next one is hurting the people making money is even harder. 20% capital gain rate right now, plus 3.8% net investment income if you make over $250,000. But this is the dangerous part. If your income make it over $1 million, they propose no more capital gain. No more capital gain. You pay regular tax. What is a regular tax? 39.6% plus 3.8, 43.4%. 43.4%. Guess what? Anybody make over $1 million, if you sell any properties, sell stocks, even with a long-term capital gain, you have to pay 43.4 on federal only. If you at states like California, you're going to pay up to close to 60% when you sell the property. Do you think that's going to hurt the market? Of course, that's going to hurt the market. So, if I will say, if the new proposed tax change, the stock market, because when you increase tax from capital gain from 20% to 28%, number one, the company C corporation from 21 to 28, stock earning will be less. Company want the downsizing. You're going to start laying off people. You're going to hurt real estate market as well. Okay, business owner, because the tax increase, they might don't want to reinvest anymore. They don't want to expand unless they understand. The business is going to get hurt. So the whole market going to get hurt. The whole market going to get hurt. So that's why tax planning and tax coaching is even more important down the road. And also, Biden tax increase also changed estate tax too. So estate tax exemption from 11.7 million this year probably dropped to 3.5 million to 5 million. Estate tax rate 40 to 45%. They were talking about eliminate step-up basis or 1031 exchange. Personally, I don't think that will pass. Why? Because you're going to hurt too many people. I didn't have time to discuss about this. In the next 1 or 2 months, we have a special session. We're going to discuss about it. Why I don't believe taking away step-up basis or take away 1031 will actually pass, because too many people are going to get hurt. Okay, but drop the lifetime exemption and increase their estate tax, only hurting small number of people, yeah, they probably will do that. So more people gonna have estate tax issue, estate planning issue, stamp planning issue. So when we do estate planning for a lot of people, we're gonna tell them family, business, trust, charity, what is the best combination? Okay, so when we talk about this, now people said, how can we help people? Your tax coaching sounds very expensive. Is the matter? No, not at all. We can help you to review your tax return. We only charge you if we can save you. How much we can save you, since we're part of the EXP, a member too, we have EXP Realty. So we'll talk about all the EXP people. We only, if we do tax coaching with you, first we provide 20 to 30 minutes free consulting the first time. And then also, we only charge you 10% for whatever tax we can save you compared with the last 2 years. And we put a cap, is up to $2,000. With up to $2,000, that's the one we're going to charge you. Only charge you by the tax we save you, the 10% tax we save you up to $2,000. But if you are our client for whatever solo 401k, insurance, annuity, or other different product, we can even apply the money we charge you, apply to the fee you need to pay to set up a solo 401k or other plan. So we have a lot of things we can offer. So if you're interested in what we said, if you want us to help you, do not need to overpay your taxes anymore. You want to understand a little bit more about what taxes are all about. You want to teach yourself what is the best way. If you want to, we're not here to take your accountant or CPA away. We're here to give you education, second opinion, and help you evaluate your tax people. Are they doing the right job for you? Guess what? More than half the tax return we review, either they make mistakes or we can find a lot more tax saving. We can help them. Okay, use this as my ending. If you are sole proprietorship, self-employee, receive a 1099 income. If you never set up a corporation or your income didn't go to your corporation structure properly. I know some of the EXP people, you can only get in from personal, but you still have a way to transfer your personal income to corporation. Then you can structure in the corporation. I'm sure you overpay $5,000 to $15,000 or even more for your income taxes already. Our job is make sure either if we still have time, we get some of your money back, or we make sure from now on you never have to overpay your tax anymore and do a much better tax planning. And one thing, remember, if you try to do tax planning at 2021 for tax for year 2020, you're too late. Now it's 2021. You should do tax planning right now, before year end, from now to the year end. Why? Because 2022, you do tax filing, but you don't do tax planning. You need to do tax planning now instead of 2020 when it become too late. So if you're interested, anybody interested in our tax coaching program, let us know so we can start helping you and to make sure you don't overpay your tax anymore. Thank you.
You're a Pisces.
Okay.
Hey, I don't see Fee. Are we missing Fee?
I do not see her either.
I don't see her either. Courtney in the room?
Looks like she's typing something. Well, I tell you what, folks, since it's quarter two, and out of respect for everybody's time, we are going to get started. We are missing Fee Gentry, who probably got lost on the way over here somehow, but we'll find her in a second. First, want to say I'm Randall Miles. Very happy to have you join us. This is always, I think, a great conference. It's always a great session. I think I speak for everybody in saying that we're looking forward to the time that we can do these things in person again. And that will hopefully be in November in Las Vegas. This track is a little bit different than what was scheduled. You probably saw that Gene Fredericks was going to moderate this particular discussion. As it turns out, he was double booked. And between I and Elizabeth Riley, he felt it was safer not to upset her than me, which is probably the right choice. So we'll make do here. Welcome. We have on the panel today myself, Dan Kahir, Darren Jacklin, and Fee Gentry, and together with Glenn Sanford, Jason Gessing, make up the board of directors for the company, as well as Gene. And we've got a number of things that we'd like to sort through, culled from a number of questions that we've gotten in the past, or questions that come up through the year, or things that are topical. We only have about 45 minutes, I think. So we'll have to move through it as each one of these topics can take up the allotted time. So, kind of the starting point perhaps is, what does it mean to be on the EXP board of directors? Many of you have probably served on nonprofit boards or others. Serving on a public board is similar in many ways and also quite different in others. In short, we have a fiduciary responsibility to the broad constituency that we serve. That includes shareholders, agents, employees, customers. Our responsibility is to provide advice and counsel and regulatory oversight for the company. We don't manage the company. That is management's responsibility. We are a resource and an independent review of management. We review and approve the annual budget, the annual strategic plan, and engage in constructive debate around any important issues that management brings to the board. That regulatory oversight that I've alluded to includes things such as compliance with SEC rules, regulations, and guidance, financial compliance, particularly through the audit committee, which is composed of all independent members of the board of directors, working very actively with our accountants and the like, charged with oversight with respect to regulatory compliance much more broadly. So at the heart of it, without belaboring it and without going into too much detail, that is the charge of our board and what we spend a healthy amount of time on. One of the great things about conferences such as these that are held in person for us is that we don't often have an opportunity to get in front of agents, to meet all of you, to connect, to hear about the things that are important to you guys. So again, we're looking forward to that in the future. And I would invite, if we don't have time for many questions at the conclusion of this, for you to reach out to us anytime with any questions that you might have. But again, at the highest level, that's what we try to accomplish as a board. Dan, is there anything perhaps you might like to add to that description?
I think that it's incredibly important to us to do everything that we can to help the company succeed in the long term, and the agents of the company, of course, are incredibly important to us. And so it's always wonderful for us to have these opportunities, as Randy said, unfortunately not in person this year, but to have dialogue with you, to meet you, to speak with you, and learn about what's going well, what are opportunities for the company to be able to improve. Because at the end of the day, we have a fiduciary duty to shareholders, but for shareholders to do well in the company, which of course includes all of you, means that the company needs to be doing the right things for all of you and for the long term. So, we always really appreciate the opportunity to have these kind of interactions.
And I'll emphasize long term. I think Dan mentioned it 2 or 3 times. There are a lot of things that we can be focused on, and it is our responsibility to take the long-term view, not the short-term quarterly view that is a trap for many companies. Our job is to ensure that we can continue to sustain the kinds of growth and opportunity, and sometimes that means making decisions for the long term that may be detrimental in the short term, perhaps in terms of how we make investments and the like, but yield long-term beneficial results. So Dan, I'd like to stick with you for a second. We all have our own path insofar as how we came to EXP. Yours is a little bit unique in that your first introduction to the company was that of an investor for looking at it for the benefit of a family fund. Perhaps if you don't mind, describe how you came into the company and contrast that, if you will, insofar as the view you may have had then and the view you have now, given the evolution during your time on the board.
Absolutely. So as Randy mentioned, my day job has been investing on behalf of some of the most successful entrepreneurial families here in the U.S., including having worked for the Walton family, the founders of Walmart. And as we look to find long-term investments, one thing that's always been really important from an investment strategy perspective has been finding founder-led businesses. It's a theme that has been, very successful for us historically. And one of the reasons that we seek out founder-led companies like EXP is that there's often a very clear customer focus and clear ability to innovate quickly. Oftentimes the founder understands the customer extremely well. In this case, Glenn and his deep experience as a real estate agent enables both an understanding of what the customer needs, but also an ability to move quickly and not get overly caught up in bureaucracy and making decisions to serve that customer. You can look and see some of the most successful companies out there: Facebook, Apple, Netflix, Google. All either are founder-led or were founder-led during their formative years. So we found our way to EXP a number of years ago, actually as the first professional investment firm to reach out to the company back when it had a market cap of about $80 million, and actually came to a similar event in San Diego to learn more about the company, and in particular to see how the company was serving agents. And a couple of things really stood out from that initial experience, which was the degree of enthusiasm among agents, among people such as yourselves listening to the presentation today, was just unlike anything I'd ever experienced as an investor. It was this really magical combination of a founder-led business where, as I mentioned earlier, the founder deeply knew the agent's needs, but also surrounded by a team of other EXP employees who clearly deeply cared about building the best possible company for agents. And at the same time, an industry where there was a real opportunity for disruption, for a technology-driven solution to be more cost efficient and offer something better for agents. And so that really jumped out at the time, and has continued to be the case today. And I think, in terms of the second part to Randy's question, which is what's changed over the years, I think the biggest thing that's changed has been, as the company has grown, it's always been stewarded very responsibly from a financial perspective and has been cash flow positive throughout. So EXP is very unusual in that it never raised investor capital as a private company, and it actually went public not through an IPO, but actually through acquiring an existing public company. So everything has been done within cash flow. And what that's meant is that as the company has grown, it's gotten more and more resources to be able to invest in making onboarding better, making agent training better, making transaction processing better. And so it's one of these things where, it's really been just fun to watch. the offering has gotten, I believe at least, just better and better as the company has grown. But even in those early days when there was still a ton of technology to be built, and of course there still is much to build to make things better and more efficient, still the amount of enthusiasm that was there was very evident, and I think hasn't waned over time.
That's a great point. And I've said on this stage several times in the past that one of the things that has always been remarkable to me is the degree of enthusiasm that exists in this company at every level, inside and outside, unlike anything I've ever experienced in corporate life as well. Thanks, Dan. Darren and Fee, I'd love to ask you guys a question as it relates to, we've been so fortunate to have a great vision and a great business model that has been very attractive to agents, and we continue to see the pace of our agent growth to be really, really strong, which continues to be remarkable given how quickly we've already grown. Fee, you're on the board in part because you bring a great skill set, but in part because we do reserve a couple of spots on the board for an existing agent with the company. And Darren, you spend a great deal of time with agents, particularly in Canada, but certainly not exclusively so. What is it that attracts agents to EXP, and what are we doing to ensure that we continue to be an attractive platform to draw agents, not just from the US, not just from Canada, but given the fact that we're in, 15 countries or so now from around the world? Fee, why don't you start it off?
Sure. First of all, good afternoon, everybody, and thank you all for taking your time out of your afternoon to spend it with us. So to answer your question, I'm going to piggyback a little bit off of what Dan has already said and what you've already said, Miles, is that we have a great competitive business model, and that was started from the DNA of the company, but then we continue to have better offerings. And so while people come for our compensation, they come for the cloud technology, the thing that is very undervalued in the metric that I think they're coming for is the community and the culture and the collaboration. That's the most surprising thing that we find that happens when agents come here to our culture. And we put a business metric on it now because we are now have this open platform. We're sharing our information. We're taking agents from where they are in their businesses to where they want to be, and our agents and our influencers have done a really great job of broadcasting that and showing that in dollars and cents through our productivity. And then on the global side, again, we go in, led by Michael Valdez, go in and look at the very top companies in those countries, and then come back and reverse engineer it and find the best offering that we can so that we're far and above, and not just by a little bit, but far and above what other countries are offering in their respective realities.
Yeah, for myself, good afternoon, good evening, everyone. For myself, really looking at how we're a relational company versus a transactional company, and that we deeply care about our staff, our agents, our brokers from around the world that are part of this company. Also the core values, our founder, Glenn Sanford, some of you know, and some of you who don't know Glenn yet that are in the audience or fairly new to EXP, when we get a chance to be in person, you'll get a chance to meet our founder. And that's something that's really remarkable with our company that stands out amongst a lot of other companies out there across the planet, is everybody in our organization is approachable. They're accessible. Glenn fits in just like the agents, and he's our founder. Jason Gesson, our CEO. Another thing is a lot of collaboration. As you know, the last 24 hours has been a lot of collaboration going on here. And this is our investor conference, our shareholder summer conference, which is different than we do in the fall when you see our EXP Con, which is much different. And then also, too, us being a global family. We're in 15 countries now on 5 continents. We're growing and being led by Michael Valdez and his team, which is incredible. And also with the acquisition in the last 6 months of Success.com, Success Enterprises, which is really huge in terms of training development and personal professional development, and also being virtual and location dependent. This model was built to be efficient, to be effective, to buy back time so you can enjoy doing the things that you want to do on your terms, no matter where you live on this planet. You can be virtual and location dependent. So if you want to take your kids away for a few days and get away out in the mountains or travel, as long as you got access to technology, you can be virtual and location dependent. And that's cool. And also too, is that we provide multiple income streams for an agent or a broker. and which is awesome because a lot of times you're just trading time for money as a commission salesperson. But we offer incentives if people want to take up those opportunities to be a part of that and grow and expand and lead and just live an incredible life. There's so many great opportunities here. You just have to plug in, show up, do the work, and ask for help when you need it. And there's always an open hand here.
Yeah, thanks, Darren. I mean, this really is a unique business model. There isn't any place that I'm aware of, certainly not on this scale, where we have as many people associated with the platform, employees and agent users, who can be any place on the planet at any hour of the day and interact with their counterparts or other people in the company as effectively as we can do in our existing technological platform. Pair that then with a compensation model that is unique in this industry and unique in many, and it's really been a pretty strong platform that we continue to evolve and continue to develop. I'd like to next move on to something fairly topical. We've done a couple of things in the recent past that include the split of the company stock, and there have been a lot of questions as to why, what does that mean, what's the stock doing, and all kinds of stuff. So maybe a quick word of explanation as to some of that. We split the stock toward the beginning of the year, and the practical effect of that, for those of you who may have asked the question and aren't familiar with it, is it's basically a non-economic swap. Meaning, if I can use an example, if you had 100 shares and the price of the stock was at 50, just to make up a generic example, pre-split, once the stock splits, you had 200 shares at a price of 25. Each circumstance providing equal value to you as a shareholder. No economic swing one way or another. Why do companies then choose to split a stock if there's no economic effect? The reasons for that can include, and in our case, the stock had run up to a pretty high price, and we felt that it would be more attractive to retail investors by decreasing the price of the stock and issuing more shares. From an administrative standpoint, given that we have an agent equity program, we felt it was better to issue more whole shares, if you will, as opposed to fractional shares that people had to accumulate before they were of any meaningful value. So we did it for that reason. We had to increase the number of shares outstanding to do that, but it had no economic effect on your holdings, no economic effect on the company. Oftentimes, people will associate something more broadly than that stocks trade up or down post-split, those sorts of things. Anecdotally, those things happen, but there's no economic basis for that to occur. The other thing I will mention, as the question has come up, frequently, we've seen the stock decline. The stock markets move all over the place. We have no control over those things. People have wondered why we don't comment on that. The fact of the matter, folks, is that our job is to focus on the day-to-day metrics of the company and how we move forward, not to manage our stock price. To do so, frankly, could have us all end up in orange jumpsuits, and I don't think it's a good look. So we're particularly focused on how we operate the company. And I'll borrow from an interview that Jeff Bezos did a number of years, and I can't remember whether it was 60 Minutes or whatever else it might have been, or I would cite that. But it was at a time when Amazon stock had fallen from on the order of about $113 a share to $6 a share. And he was being asked about that. And I'll paraphrase his response insofar as how I think it affects how we view this business. And that is, the outside world is going to view us or anybody else the way it does. We can't control macroeconomic factors. We can't control interest rates. We can't control how the market views technology companies or real estate companies. And the market has not been kind to either the last couple of months. What we can control and what we focus on are the kinds of things that drive this company forward, the kinds of metrics that we see as very strong factors driving our growth, which, by the way, are great, and they're getting better faster every day. And those are things like agent growth. We've seen agent growth in this company really increase. We continue to grow apace. It really is quite extraordinary. We're very proud of our ability to attract agents. That corresponds to revenue growth, which we've seen escalate pretty significantly. Our profitability continues to get better and better, and we have a tremendous amount of free cash flow. Dan alluded earlier to the fact that we have grown this company organically. We have invested our own cash. We haven't had to raise independent capital, outside capital on dilutive terms to be able to fund our businesses, not just our core, but to expand our opportunities into other business lines, whether it's growing internationally, adding commercial, or buying something such as Success Magazine. So at the end of the day, we are a multi-billion-dollar revenue company with no debt, with significant organic growth, with a huge amount of free cash flow. Do we believe that we're undervalued? Sure we do. Do we believe that we're undervalued relative to our peers? Sure we do. We believe that if we continue to focus for the long term in the kinds of things that we as a management team and we as a board drive value in this company, the market will take care of itself. So for those who spend their time looking at the stock, frankly, it's hard not to do that when some portion of your wealth is made up by those holdings. But the stock's going to go up, the stock's going to go down. There's too much we can't control. We focus on the stuff that we can. Dan, you want to add anything to that?
Yeah, the only thing I would add is, if you look back over history and you looked at, say, our stock chart or any company's stock chart, within there, if you kind of zoomed in on any time period, there are numerous different periods of declines, and it always feels bad during those periods. You can even think of Berkshire Hathaway, where they have an unrivaled track record of growing the stock at an average rate of 20% since I believe the late 1950s. And they have had 4 different periods of a greater than 50% stock price decline. And so this is just kind of part of what naturally happens. The market's way of viewing a company tends to change at a far greater rate than the company's fundamentals are itself changing. And the key, as Randy said, is just kind of continuing to think long term and do the right things in the business. And there will be volatility. This certainly won't be the only time. And it's just kind of keeping a level head and not being overly swayed by what an unknown person or algorithm might be kind of valuing the stock at on any given day.
Thanks, Dan. So, Dan, I'll stick with you for a second. The last year was challenging for every company and every household. The COVID pandemic wreaked havoc on people's incomes, job stability, created concerns about mobility, to say nothing of the tragedy of loss of life. We did a number of things as a company to respond to that, to position ourselves to survive and in fact thrive. Maybe if you'll recount some of that, and Darren, I'll ask you to do the same.
Certainly. So that period beginning the last February is in some ways a blur for me, and I imagine for many of you, because we're all in it together, trying to figure out exactly what was happening and how to react, and how to operate in this very uncertain environment. And so the board was meeting at times every week or every other week with management, and everybody was trying to both just understand the real-time information as it was flowing in and figure out the most appropriate way to respond. We made early in COVID, real estate transactions slowed dramatically, as you all know, as folks really wanted to hunker down and stay at home as we tried to figure out what was happening and what the risks were. And so we made at the time the very difficult decision of reducing headcount at EXP World Holdings in anticipation of the fact that we were going to be processing fewer transactions, that we had a huge amount of uncertainty in terms of the amount of revenue that would be coming into the company. And as much as that was a decision that we really didn't want to make, knowing that it was going to affect the lives of a number of EXP employees, we felt that it was paramount that we put the longevity and ultimate health of EXP first, and not take any risks with that. Now, I don't think we viewed ourselves as sort of close to the edge in any way, but we just wanted to be very safe and be very careful. So that was a very difficult decision that the company made early during COVID. As things progressed, obviously the economy turned, in part due to support both fiscally and monetary policy from the government. That things came roaring back, I think, far faster than just about anybody expected. And so then we kind of quickly pivoted and went back into growth mode, and have been continuing to add to the team since. I think one thing that remained constant throughout was the fact that as a company that's been fully remote from the beginning, both in terms of not having offices for agents, but not having offices for EXP staff, we experienced far less disruption than really any other company that I know of, and we're really well set up to be able to respond quickly, and then kind of quickly start to double down in all of the things that we've been doing all along to make it a company that can function well as a company, and then enable agents to function well in a fully remote world.
Yeah, well said. Also, too, looking at last year in 2020, I've been around EXP since 2014, and got introduced to Glenn Sanford, the founder, back in 2013. And back in those days, we had just a few hundred people in the entire company. We were operating in Washington State and in Arizona, and we weren't even across the United States or Canada or anywhere internationally. And I remember how people, when we were onboarding new agents and people were in discovering due diligence process with our business model, and we're in the early stages, people were laughing at us and making fun of us and said, your business model is not sustainable. It's not going to pass an economic downturn like in 2008 or 2009. You need the physical bricks and mortar. You need the franchise. You need the big brand names to back you up with deep financial pockets and decades of years of experience of history. And it was really interesting because last year in 2020, when we went through the global pandemic of the start of it, of that ripple of impact, a lot of people really started to look at our business model. And, there's been a saying that there's 3 stages in business or in life. Step number 1 is you're ridiculed. Step number 2 is it's opposed. And step number 3, it's served as self-evident. And in 2013, 2014, all the way up till just not too long ago, we were always being ridiculed by people in the industry and different people in the industry. They would laugh at us and make fun of us. And then in 2020, a lot of eyeballs really got onto our business model. People said, okay, this EXP, are they going to really be sustainable? Can they really stand the stress test of dealing with this global pandemic? Do we need to be virtual? Do we need to have physical bricks and mortar? Do we need to have franchises? And it was really interesting in terms of our numbers, because numbers don't lie. If you look at our metrics in last year, our numbers went up in terms of agent attraction, growth and expansion, Michael Valdez. And so it was really impressive to see the stress test that we went through under great, global pressures with this global pandemic, and how we performed and how we started to attract high performance teams and agents and media attention. And it's just been really incredible. So, time will promote you or time will expose you. It's just a matter of time whether you get promoted or get exposed. And during 2020, we got promoted to another level of visibility and exposure in a positive way, that people really started to see, wow, this model is sustainable, it's long-term, and in this virtual world, we can still collaborate, we can still communicate, we can be efficient and effective, and we can still at the end of the day make things happen and get things done.
That's so important, Darren. And I think, one of the other things following Dan and Darren here on the subject that we were able to continue to pursue, in fact, accelerate during a difficult year insofar as things that were affecting the world, is our expansion. That is the acquisition of Success Magazine, expansion of commercial real estate, expansion of our international opportunities. The result of having achieved a level of scale focused on ensuring that over the last couple of years, we had built sufficient infrastructure to carry us well into the future without significant additional capital investment to do so. That we, having reached a point where, while expenses in absolute terms go up, but expenses in key categories as a percentage of revenue, for example, were beginning to decline, reflecting that we had achieved a level of efficiency and scale that we could then expand our strategic thinking to take advantage of opportunities to move into new markets, both in terms of product, commercial, and in terms of geography, international, and take advantage of opportunistic situations such as success, each of which will be accretive and each of which will contribute materially to the growth of the organization, and each of which will expand our margin opportunities. And we were able to do that during a very difficult time. And it's the result of a great deal of planning that occurred previously, a great deal of investment that we've made in this company to give us that kind of flexibility. So we've grown extraordinarily quickly. Have we grown too quickly? No. For those of you who've heard me say this in the past, it will resonate. In the earliest days of the company and continuing through this day, we are ever mindful of the fact that significant growth has imploded other companies, and we are therefore very mindful of ensuring, as I mentioned earlier, that we have the appropriate infrastructure in place, that we're taking every bit of a 5-year view relative to doing the kinds of things now that will allow us to keep our foot on the pedal, continue to grow, do it efficiently, and do it in a way that adds to our ability to scale the company and increase our margin opportunities. Thanks, guys. Sophie, you're the newest member of the board. You are a very active real estate agent, not just out helping consumers, but very active with the agent community in this organization. Maybe describe a little bit, your experience as the newest member of the board of directors and your observations and the kinds of contributions that you, as an active real estate agent, are making and can make on behalf of the people that you represent.
Wow, that's a great question. Like I said, it's been my highest and best honor to do this, and it's almost been a year, right? I can't believe the time has gone by so quickly. And so on a day-to-day basis, I serve in several different capacities. And you guys always know behind the scenes, I say that my name, they call me Google because I have so many people coming to me for so many different things. But the one thing that I get to do is always be the conscious and the agent voice. And that's by looking at our work groups. I kind of work behind the scenes with a lot of our one EXP diversity and inclusion groups. Do you want me to talk about that right now?
Well, that was going to be a segue into that question. So if you want to weave it together, that's fine.
Sure. So I get to, on a day-to-day basis, work with our one EXP diversity and inclusion initiative, which we're also weaving that into the business component of it, right? So that makes sure that our agents, that they stay, that they have a place to belong, and then that they're productive while they're here. And so what we've been really focused on is growth, retention. So growth, retention, and then building assets for our basic communities. And that's in the form of external facing, because we've done a really, really good job of building EXP's foundation. Now we're going to start continuing to build externally our outward bound technology, our outbound facing public landing pages. And then as the cities and the states open up, we're able to put boots on the ground and create what we call a land army, or what we call our special ops, going out and doing growth development, retention strategies with all of our agents. And now, you want me to keep talking about some of the things that we're looking at?
Yeah, please, okay, go ahead.
Sure. So for example, one of the things that we were able to accomplish in the last year since COVID, and it's really shown how well this technology holds up, is that we've had virtual conferences, and we believe that Verbella has been such an instrument in having that happen. We've seen that our agents and other entities are learning a new behavior, and I think we're training a whole new generation of how to do business in a virtual platform. And that's really, really key for people to pay attention to, that we are not only training employees on the workforce side, but we're training agents and next generations of agents on how to operate in this world. And so we think that has happened and it's led to more productivity. We're focusing on our next generation. So for example, in the 1EXP initiatives, we're focusing on our millennials, our senior citizens, because that's where the wealth is still. Our women are trending as well in this company and out in the greater workforce. And so we're really focusing on those agents. And then those agents under the age of 36, we are really looking at them as going to those individuals to have them consider real estate be a second career or a first career, as opposed to what we now done in our generation of being at a third or fourth career. So we're looking at those individuals. What else do you want me to talk about? I mean, I can go on for a long period of time on this stuff. So come back to me on that if you need to.
Well, and I think, Fee, what's made you such a great addition to the board is, in addition to being an active real estate agent, you've brought real perspective relative to going beyond simply giving lip service to diversity and inclusion, to training, to preparedness. It wasn't so long ago, a couple of years ago, that we would have probably said that EXP was perhaps not a great real estate career. And I think that has changed significantly. And the reason for that is we spend a lot of time, a lot of money on investing in training, investing in creating the next generation of successful real estate agents. We are fortunate to have very strong groups of icon agents and other successful agents in the company who are very involved with passing on. Part of their legacy is helping others be successful. And I've told this story a couple of times in the past, and I can't remember which session and which conference it was, but I think it was maybe about 2 years ago. It was an icon discussion that was led by icon agents, and the particular focus of that discussion was, how can we get more people to achieve icon status? How can we get more people to achieve success? How can we impart our knowledge, our tools that have led us to be successful to others? And I think one of the great hallmarks of this company, one of the great hallmarks of our culture, one of the great benefits of how we operate virtually is an ability to connect with people everywhere. We're not dependent upon flying trainers to a variety of locations to train 30 or 50 people at a time. We have on-demand training available 24/7, wherever you may reside in the world. We have the ability for people in San Diego to connect with people in Boston or anywhere else seeking to glean from others what has made them successful. And an extraordinary amount of very giving people, very collaborative people who want to help do that. So I think, from a cultural standpoint, from the very beginning, this has been a company of inclusion and of collaboration, and it's very fitting that that's a significant part of our culture. Dan or Darren, any comments you want to add to that?
Not from my end. I think you hit it really well, being Randy.
And so Dan, comment on from your perspective, both wearing your EXP board hat, but perhaps more specifically, even outside of that, kinds of trends and what's coming down the pike here that you think both represent opportunities and challenges that we as a company need to be mindful of.
Well, I think we're seeing in the real estate industry, as really every industry, that the rate of impact of technology is accelerating. Unfortunately, EXP is in the role as a tech-enabled disruptor, which is a wonderful position to be in. But when industries begin to change quickly, it can often be difficult to predict exactly what the end state of the market will look like. And so while we of course, do our best to anticipate, where the puck is headed, not where it's been. For example, with our Express Offers platform to enable agents to show their clients' homes to a plethora of different iBuyers. That's a big iBuying is obviously a big trend impacting real estate, and we think that we're taking the right moves to help EXP agents and their customers to be able to kind of capture that. But the reality is things are evolving quickly, and so something that we think about a lot is, of course, we're going to put our best foot forward in a variety of different areas, affiliated services being another, as it relates to our core business. But we also think about how do we maintain our ability to iterate quickly. One of the things that can kind of change companies from being a disruptor to being an incumbent who gets disrupted is that as the number of employees at a company doubles and doubles again, there can be a tendency for groups to become siloed, things to move more slowly, and it's something that is very important to Gwen and the management team here. How do we remain agile? How do we continue to move quickly and avoid that kind of entropy that can occur? So I think we're being very intentional, not only about trying to stay in front of the trends and build the right things to make sure that EXP and its agents are in a very good spot over the long term, but also how do we kind of keep that muscle memory of moving quickly, which can be challenging.
Darren, anything to add?
I think that, if we look at ourselves, all we are is a network of conversations of human beings. And this is a global business. And I think a lot of times when people go out and they do all the studying and training to get their real estate license, they start to work in their geographical location of their area. I think coming here really expands people's mindsets to think bigger, to really realize like, wow, I can build in multiple different states or provinces or territories or different countries, or I can build a business across North America, or I can build a business that expands right now 5 continents and 15 countries. Yeah, it's going to take work and time and effort and energy, but you put in a lot of hard work and time and energy, and you collaborate with like-minded people that are in this environment. And over the next few years, you can unfold in front of you a global business. And I think it really expands people's mindset that a lot of times, in society, we come from a lack and scarcity mindset. What I really love about the culture here with EXP is the abundance and prosperity. We want you to think bigger. We want you to expand yourself through training, development, and through mentorship and guidance and collaboration within this environment. And we want you to thrive. We want you to live an extraordinary life on your terms, however you want to define success, whether it's for you and your family, it's for you and your community, it's financially, however you define it. And I think it's a really great opportunity. And I've got a chance to really watch and observe a lot of men and women over the last few years being in this environment, like all of us here on the board. And we've seen people come in and what their first 90 to 100 days is like, getting caught up to understand the world and the technology and being virtual. And then all of a sudden you start to see them grow and scale over the next, several months and few years. And it's just been incredible to see the, if we were to do case studies on the different men and women who've come through our model over the last few years, how their lives have changed, but also the ripple of impact in communities that they serve and geographically live in. There's been incredible amounts of success stories of everything from humanitarian to philanthropy to philanthropical to all kinds of things, to volunteer work in different communities. And I'm really proud of all the agents and brokers and support staff of this business, because we've really created a ripple of impact in terms of making a huge difference on this planet. And I believe that, we're in 15 countries now on 5 continents. We're really just starting to get started with what we're doing. And we're coming together as a global family and as a global village. And it's never been done before, what we're doing on this planet.
Well, and it's an excellent point. We've been, very successful in the U.S. market, performing very well by any measure. We're performing very well in Canada, given the growth that we've had there, and we're really just at the early stages in the rest of the world, and we've grown, very quickly. That is, we have entered new markets in a variety of different countries, and we're at the very early stages of what we believe will be some pretty significant growth in those areas that will contribute to, if not in time, dwarf the U.S. Huge markets out there. We've offered a model in every country that we're in that in large measure is unlike any of the models that have pre-existed in those countries. It's some variation of what we offer in terms of the incentives in the U.S. That have to fit within the regulatory boundaries of individual countries and what the existing model is. But it is an extraordinary start. And what we're seeing, for example, in commercial real estate and our ability to track commercial real estate agents, the degree to which existing residential agents who have handled some commercial in the past are getting trained and adopting the formulas necessary to be successful in commercial real estate as well. We're just at the beginning of seeing just how successful the Success Magazine acquisition will contribute to the organization. So frankly, we're hitting on all cylinders. We've been able to do that through a pretty difficult time in global markets, and it's therefore a pretty exciting place for EXP to be. Dan, what's keeping you up at night as it relates to EXP?
I suppose probably there's two things. One is what I mentioned before, which is how do we continue to move as quickly as before as we grow as an organization? And I think we're doing the right things to ensure that, but you still always have to worry about going from being the disruptor to being the incumbent who's getting disrupted. And then second of all, as we scale in terms of the number of agents, in terms of the number of staff, the company has very clear ethics and values, and we all want the company to continue to grow and prosper, et cetera. But as you get larger, there's always the chance that you have somebody join who's a bad apple and in some way takes an action that doesn't represent the ethics or values of the company. And so you always have to think about making sure that we have the right systems and controls in place that doesn't happen. But that's inevitably something that keeps me up at night as well.
And it's worth noting for folks that we do have many of those systems in place. We do have, both for our own internal benefit as well as responding to regulatory necessity, an ability from a whistleblower standpoint for people to report either directly or anonymously if they believe there's been any wrongdoing on the part of an employee or on the part of an agent. So we have a number of things in place that respond to that. But I would echo that, Dan. I mean, you can't control all things and all people, and what you know, and it's always the stuff you don't know that is somewhat concerning. B, what would you like the legacy of EXP to be? If you project yourself 10 years forward and still part of an organization that has demonstrated a significant amount of success between now and then, what does the legacy of EXP look like insofar as its impact in real estate or beyond?
That's a great, I love that question. I think that I would love to see us be the most, obviously the disruptor, but us to be the most diverse and inclusive real estate brokerage in the world. I like for us to have an impact and an economic footprint all over the world, so that we're not just coming into countries and domestically and abroad, but to tell the story that we're the company that changed the industry and that we did it in our own way, on our own volition, without bricks and mortar, and that this is the business model that has created a whole new industry. So that's what I love to have us do.
Darren.
I'd say looking out into the future, global household name globally, that we are a model that is talked about and trained and developed in schools, colleges, universities across the planet, that we create a safe environment for people to grow and develop and to dream. That people, I've talked to a number of different agents from different brokerages and organizations where as soon as they got thinking really big in a small market, they got, as in Australia, they call it the tall poppy syndrome. They cut your legs underneath you. And here, allow people to dream big and expand themselves, but also be a model of integrity. I think the next generation is watching us, and I've always believed that without integrity, nothing works. And I think it's so important that as we grow internationally and expand with different cultures and different countries and different continents, different beliefs, that we show and we demonstrate by our feet, not our lips. Because I always say, watch people's feet, not their lips. That we demonstrate our core values, and that it's impossible to do business with integrity, and it's possible globally to be relational versus transactional. Is that you feel like a human being versus just a number, or someone's trying to get something from you. That rather someone's trying to contribute and make a difference in your life. And I think that because we're a founder-led company with passionate men and women that serve this company, that get up every day and work hard, put in a great effort and time, that I think, I'm a big believer that, time will either promote you or time will expose you. It's just a matter of time. And I see over the next 10 years that we will get promoted, not get exposed.
Dan?
I think Fee and Darren said it incredibly. So the only thing I would add is just, my hope is that each agent who's part of EXP is better off for the experience, and that truly we are able to improve the lives of the agents who work with EXP.
Well said. And as we draw to a close, I think just a couple of things to sum up. I hope you have the feeling that we as a board are focused on the right things as they relate to creating a legacy for this company that includes a transformation in the way that real estate is conducted, a transformation in the way that business is conducted, given the kinds of tools that we utilize, that we are devoted to a culture of inclusion and healthy, constructive debate around the kinds of things that we need to be doing as a company to set an example to others, and to provide the tools and resources to the agents we serve so that they can build the best practices that they can. I'll reiterate what I said earlier with respect to some discussion about the stock and the split and the like. Guys, we could not be happier with the way we're performing as a company. And notwithstanding the vagaries of the stock market, we are seeing a significant continuing growth in the number of agents that we attract to this company. We continue to see our trend lines with respect to revenue growth and agent productivity all moving in the right direction sustainably. We continue to see month over month, quarter over quarter improvements in our profitability. We've added business lines that, as those begin to hit their stride, will contribute higher margins to the business. We continue to have and will continue to have significant free cash flow that frees us from the burden of having to seek outside capital on dilutive terms to drive our business forward. Now, there are a variety of reasons that one may access capital markets, and I'm not suggesting that we won't ever do that if there's some opportunistic reason for doing so. But if we ever did it, we can pick and choose our spot. And for the moment, we have no need of that. We can invest day to day in the kinds of things that build our business and drive it forward. Again, we're a multi-billion-dollar revenue company. We have no debt, and therefore no drain on our balance sheet with respect to that or our income statement. We do not have bricks and mortar, so we're freed of the burden of having fixed infrastructural expense that gives us the flexibility as markets move quickly or as challenges enter this market to respond without having to have significant changes in how we operate and significant changes in the organization. We've got huge cash flow, as I've mentioned. So I know that I'm speaking for my colleagues here. We feel privileged to be part of this company. This has been an extraordinary journey that EXP has been on now this last 11 years. We see no end in sight relative to where we're headed directionally. This is a fun place to be, a fun board to be on, a fun company to be part of, and we couldn't be more pleased to be associated with the quality of people that make up our agents and employees. So I thank you all very much for joining us this afternoon. As I suggested early on, it's impossible to take everybody's questions, but you're certainly welcome to talk to us throughout the conference or to reach out to us directly at any time. So I think maybe we'll hang on for a couple of minutes on stage here, but I think we've probably all got places that we've got to be in the next 5 minutes or so. But thanks again, folks, for joining us. We really appreciate your involvement with EXPI.
Everybody. You guys are pretty quiet in here.
I suspect mics are probably turned off. So
I'll turn mine on. I brought the shake hand. Not at all. We're all kind of playing with the avatars.
Hey, all of you board members, what a great presentation. You covered all the bases. You highlighted the elements that make EXP so exciting and so important as a model for the future. And it's here with us now. So thank you for doing such a beautiful job.
Thank you.
Very kind words, Susan. Thank you.
Thank you, Susan.
So much.
Yeah, this is the first virtual shareholders conference that I've attended personally. And I think it's amazing just what you've done to put this all together. And I'm hoping that a lot of other companies do the same thing. This is, it's just an amazing opportunity to listen to you and interact, as somebody who's investing from the outside.
Well, it's worth noting that we do provide opportunity for other companies to do this thing. Our Verbella platform, the same technology that powers what we're doing, is offered to other companies. We've seen through COVID, and I can't quote and probably shouldn't quote the exact numbers off the top of my head, but we've seen really significant growth in the use of our technology to power virtual conferences, virtual investor meetings, virtual education in a variety of forms. And we continue to see that we are adding additional institutional and university users to that platform as they want to have the flexibility, even in an environment where people are returning to work, have the flexibility to do these kinds of things to at least augment the face-to-face stuff that they might otherwise have historically accomplished.
Yeah, it's amazing. I plan to share it with a number of other people. I didn't realize, I knew this, but I didn't realize that you had developed this. Or did you buy it?
We bought it 2-3 years ago-ish. This was a platform that had its genesis in the educational environment, remote education, developed in California. We became the largest user of the platform and felt that there were things that we wanted to add to it, and felt, frankly, defensively, that we wanted to own it, to control our own destiny. Sure. Invest in that accordingly, which we've done, and then began to offer that to the outside world as an additional business line.
I just add, it's one of those things that, we realized over the years as a company that was fully virtual that we needed a type of tool that was different than what was out there on the market for the most part, in order to be able to have everybody, have all the employees of the company work virtually, but still be able to have some of those, happenstance interactions that happen in an office space, and develop the kind of connections that occur when you can, see somebody, even if it's, seeing their avatar as opposed to seeing them, in real life. And so it's one of these things where, you start out operating in essentially the way that we've now been all operating in COVID, and you come to realize, some of the tools that you need And we were just in the, the kind of fortunate position that, the company from the beginning had decided to operate in that way. And so it kind of led naturally to here.
Hey guys, I think we're probably about to encroach on the next meeting. So we're going to have to move on, and I've got another one I have to move on to. Michael, I invited you to contact me directly. You're more than welcome to do so.
Appreciate that.
Thanks,
Okay,
everyone.
guys.
See you.
Thanks, everyone.
Okay, stay healthy and happy.
What's the next meeting here? Does anybody know?
I do.
Yeah, hi, this is, go ahead, Brian.
Hi, everybody. This is Brian Hoylman. I'm the VP for Inside Real Estate, and we are the company that powers the KV Core platform, which is the main CRM and marketing and management system for EXP for their agents across the corporate structure. We're introducing a new farming product. It's been, there's over a few hundred agents now with EXP that are using it, but we're introducing a exclusive farming product to agents that connects within KV Core in a way that and so we're just introducing that now and giving agents a better understanding of how to farm and generate more opportunities for sellers as well. So we're really excited to present this and the concept and making sure every agent's aware of this opportunity for this new and exciting app that we're introducing and showing people. So some people are here for that, and we're recording this call so that we can then introduce it to other agents within EXP's ecosystem.
Brian, should we get going?
Sure, let's get going.
Great.
Hi, everybody.
Great. Yeah, welcome everybody. And we've got Nathan Montgomery here, who's an agent with EXP, who's going to be joining us today. I don't know, Nathan, if you want to come up to the stage.
He just walked up.
All right, welcome, Nathan. Great.
Thank you.
Yeah. So my name is Harrison Jenkins. I'm with Inside Real Estate too. I've got a couple of colleagues with me as well. Brett Dykes and Rose Campano, and then of course Brian, who heads up our strategy group at Inside Real Estate. And we have Nathan Montgomery. Nathan, I'm going to give you a brief introduction, but hopefully you'll add anything I've left out. Nathan is with the Global Connect Collection, specializing in residential real estate on Florida's Space Coast. He is also the host and producer of the Let's Chat Real Estate blog and podcast. Nathan, really happy to have you here talking about your experiences with Nosy Neighbor. But before we kick that off, Brian, there's probably some folks who aren't familiar with Nosy Neighbor. And I would just like to hear, you share kind of the insights that led to building Nosy Neighbor in the first place, and what you saw as a need with residential real estate agents.
Great, thanks, Hank. So hi, everybody. I'm Brian Hoylman. I'm one of the, again, as Hank pointed out, strategy officers here. I actually met Glenn and Jason and some of the leadership with the EXP many years ago. I was the person that brought in the conversion platform and then helped migrate EXP into the KV Core system as well. So I've been here with EXP from when he had 300 or 400 agents, working with them. I've done a lot of meetings like this and done a lot of coaching calls and such. So welcome to be here, and congratulations on all you guys' success. You guys should have a round of applause for everything that you guys have accomplished. It's pretty amazing. And so I thank you for having us here. For everybody here, early on in the conversion days, we had a Nosy Neighbor tool. So if there's anybody here that used to be back with the older product, know that when we acquired it, we moved Nosy into a holding pattern to come out with our new app. And we developed the KV Core product, but with Hank's team and his development team, we were able to put this together, and we rolled this out to EXP agents last month. Was it about 200 or 300 agents right now currently on that, I think. And now we're introducing it in this setting. So this is not new. This is something that many agents in EXP have had really good results with. And so here's the way it works, and here's what this is about. So I hope all of you can see my screen. And hi, Nathan, how are you? Good to see you here. So this is digital farming. So this is a complete auto farming tool. And the way that we developed this is, as you see on the picture, all of you guys as agents and any agents that watching this video, Nathan, I'll use you as a go-to person here. Okay. Nathan, when you, as an agent, and for everybody in the room, the most frustrating thing for me as an agent and part owner of an office was waking up, going to a barbecue, and seeing my broker owner's neighbor's house listed, and we didn't get the listing.
Right.
Been there, right? Haven't you, Nathan?
Yep, absolutely.
And everybody here that's an agent, any agent that watches this video has all been there. And there's also equally frustrating when you have a listing and then 2 doors down, 3 weeks later, a listing hits the market, they get 27 offers and you didn't get the listing. Been there too, right, guys? And over the years, it's been very frustrating for agents to have all of these listing events happen in a particular zip code, and you only get a small percentage of that. And so knowing that, I wanted to create with my team in our company a way to create an automatic farming tool that every time a listing event happens, that there is a massive farming endeavor through an automated process without the agents doing any work. So that means taking postcards and sending them out to the neighbors, creating an email database that you constantly email a landing page and marketing pages to that is automatically worked, and taking the entire, as you know, Nathan, the entire zip code of 10,000, 5,000 homes and nurturing them in Google ads, display ads, and retargeting them and creating all of these different touch points and then offering it exclusively so only one agent can have a zip code. And everybody here, and I'm sure some of you will have questions, everybody here has done one component, but not all of that can be done all on every listing, on every event. It's impossible. So what we did is we created the app, we call it Nosy Neighbor. And what it is an automatic app that is a complete farm. We'll go through some stats. We'll talk to Nathan about his experience. And what it is an exclusive app, and it runs automatically. So it does all of these things in an affordable way where agents don't do anything. And then it creates events that move into your KV core and automatically funnel prospects into your KV core, which are automatically nurtured. And so what it really is a complete farming sentence. It's doing all of this all at one time. And it's really, really fun, but also we need to set the right expectations. So I'm going to turn kind of a little, invite Nathan and Hank to kind of, but that's where a Nosy Neighbor comes from. It's the frustration of not being able to do consistent farming in an affordable way and in an effective way, and having that neighborhood exclusivity and using other agents' listings to brand EXP. So just imagine every time a zip code, Keller Williams gets a listing, Caldwell Banker, Remax, just know that within this particular zip code, EXP and you as an agent will be the only agent that can farm that area exclusively automatically. And it's very, very effective and very fun to watch agents try to figure out how you're doing this. The other thing is it really attracts them to have conversations. So I have a lot of agents, Nathan, that are getting agents to come over to EXP by farming with Nosy Neighbor, because they're finding out about your tool and they're trying to figure out how to get it and they can't get it. So they want to know more about how you're doing it. I don't know if you've had that experience yet.
No, not yet, but it's definitely, I can see that being a huge tool.
Yeah, one of my agents in Oregon had an agent complain about the fact that they were marketing to the listing and then that agent now is probably joining EXP. All right. So Hank, why don't you kind of tell a little bit about your role and kind of set the tone, and we'll kind of talk about the nuances of Nosy and answer questions. Hank, did we lose you?
Here I am talking into a muted microphone. You'd think after 14 months I'd figure that out, but thank you, Brian. I'm the Senior Vice President over the marketplace at Inside Real Estate, and Nosy Neighbor is one of our products in the marketplace. We have a few others that Brian has contributed a ton to, Property Boost and other things, but Nosy Neighbor is really about combining a number of different things related to farming into one tool. And the end goal is to get your name as the agent in front of anyone who is ready to sell in your zip code through a sustained branding effort across print, through postcards, across digital, through Google Ads, and an email, and also a set of pre-configured landing pages that all ties what we call the neighbor experience together. So Brian, why don't you talk a little bit about what happens when something hits the market, a listing hits the market, or a listing sells?
Yeah, and Nathan, I'd love to kind of tag team if you want to come up here a little bit, but sure. So at the end of the day, you guys as agents, in a perfect world, you would market your listing, and when that event happens, and I'm going to use my own personal experience. Recently, you guys, I could give you my address, you can look it up, but my neighbor across the street listed their home, and then within one weekend, Nathan, I'm sure you've been here, everybody's been here, it had 30 offers, and the price got bid up, and to the point where shockingly it was $425 a square foot. Now my house is a little bigger, I have a pool, they have a pool, it's a perfect comp, I'm on the ocean view side. Anyways, long story short, I thought my house was 1 million, maybe $1.1 million. And this is California, guys. I live in San Diego, so just note that. But after this house sold, put my house about 1.4, 1.5. And I was shocked. And me and my wife are actually considering listing. We're talking about it. My neighbor, 3 doors down, listed their home without talking or listing or showing a property or doing anything. They listed their home. They had 9 offers, all cash, without ever putting a sign in the yard. They sold. My next door neighbor next to me is listing their home. The next door neighbor directly next to me is going to list their home. And the home on the corner is going to list their home in the next few months. So basically, everybody on my street's going to list their home. There's 5 houses. I may not list mine, but everybody else is. They're all in their 50s, they're all in their 80s, 70s, they're retired. This is real estate today. And think about all of your neighborhoods. Nathan, are you seeing this in your market?
Yes, it's exactly the same thing. Multiple offers, over asking. It's crazy.
So when these events happen and you see a house listed, and everybody in this room has been there, don't you go into the MLS and check it out? Don't you go to the next door neighbor? Don't you want to see what the house is? Don't the neighbors grab the flyers and the postcards? It is the event that single-handedly has the biggest impact on anxiety, curiosity, but you can't be there for every single listing in every single market in your zip code, 24 hours a day, 7 days a week, and be the agent of record that markets to all those people, right? So you have to be all the time on it so that when a house lists, that they think of you at that moment, right, guys? Right, Nathan?
That's right.
So what we're going to do is make sure that when this listing event happens, that the first thing that happens is postcards go out to the 10 closest neighbors. And that's the more likely response rate. And that postcard goes out. Now, Nathan, have you done any marketing postcard marketing prior to coming on with Nosy in the past?
Yeah, I have. Yeah, as a matter of fact, I was specifically targeting, we live in a fairly large neighborhood. So I was specifically targeting our neighborhood prior to hearing about Nosy.
And would you say that average about, and when you know have all been there, is agents would send a postcard out, maybe they send 1,000, they might get 1 response.
Right.
Everybody here's done that and they think, oh, it doesn't work. But it's not about getting the information back from the consumer, it's about getting your information in front of them. However, when we're sending postcards out, and we have data for this, we're getting on average of about 15%, some markets 20% response rate off postcards. Now let's think about that. If you want to farm and get 1% or 15%, it's not the number of postcards you send, it's who you send them to and how you create the call to action, right? And how you create an event and how quickly the postcard goes. So what we're doing is immediately putting the postcard in the closest neighbors when they're most likely to respond or be curious. And that's automated. You don't have to create the postcard. It's like a movie, as you know, Nathan, because he's been on Nosy. Did you have to do anything to set up your postcards, really?
Nope, not a thing.
And does it and it tells you all the postcards that went out, how many went out, right?
Yep, sure does.
It manages all of that, and he does nothing. So that's happening automatically and exclusively. So Nathan has a zip code. No other agent in any brand or EXP agent can have access to his zip code to market for postcards this way. So you're using the other agent's listings and your listings, and you're owning the rights to market to those neighbors in a postcard. And there's about 300 postcards per month, because remember, postcards are the most costly part of this, and we don't want to send thousands out because we have a better way of doing that, which is the next step is making sure that the postcard, then you have emails. So we take the data from all the homeowners. There might be, I don't know how many, do you know how many homeowners in your zip code? I don't want to pull it up, but do you roughly know off the top of your head, Nathan, when you did the Nosy, was it 10,000, 7,000?
I'm not sure, to be honest with you.
Let's just say it's 10,000. We're going to take that data of every homeowner. We're going to create an email target list of all the contact records we could pull from public records and things like that. And we're going to pull those emails into your app, and we're going to automatically create marketing plans that go out and nurture those through email, because you don't have the rights to just blindly email anybody, Nathan. You have to create an event.
Right.
And so we set up an email to automatically farm those areas through your Nosy app and create an event and a marketing event. And that happens every time a listing hits. So you're constantly staying in front of this email database, which is highly productive. And again, 15, 20% response rate off emails. So you have a digital email postcard program. And then on the flip side, you also have the entire zip code where we load all of those contact records, and then we retarget them and do display ads. So when people are going on Google, they see Nathan's ad, and he doesn't. And Nathan, have you had to do anything to set any of that up?
No, not a thing.
The biggest misconception when we first launched this out with EXP, and Nathan, you were there at the beginning, is that agents thought they had to do more, right? They had to do stuff. They've had to figure it out. They had to learn it. They don't.
Yeah, that was you and I talked several times for a couple different days there, and that was my, well, what do I need to do? What do I need to do? Not a thing.
Not a thing. Nothing. And so what it does is it creates all of these touch points, and then in your app, which you will download, it manages, and Nathan can talk about that a little bit. It tells you how many emails have been sent out, how many postcards have been sent out, what prospect addresses have viewed your email, and who's clicked that. They may not have created a lead opportunity, but they're seeing your brand, and you can door knock them through the app. And then once the person becomes a lead, it actually loads it into a dialer on your app, but it pushes it over into your KV core. And I don't want to share my screen, I can. And then that creates a prospect opportunity that you can dial through your KV core. And it creates a nurture program in KV core. It puts them on listing alerts, and it sets up seller reports automatically to your community without you doing anything. Again, Nathan, did you have to set any of that up?
No, and it's been amazing to watch that happen and watch people interact with that stuff, because you see everything happening in KV Core once they're in there.
And it's in real time, right?
Yes.
See, it's all about capturing the data. Now, there's a couple things before we get into some nuances and questions that come up. And Nathan, I know we had a lot of conversations that are misconceived about farming. A lot of agents within the EXP world, and they've made comments about this, I had one today that said, well, I'm getting information from the lead that isn't the right information. This is bad information. I'm assuming, Nathan, I know we talked a little bit about this. For everybody on this call and for the recording, you're not worried about that, because the data might be from somebody who sold their house 2 weeks ago. It's not a prospect. We're capturing the data. You're marketing to the new home run. Maybe the data hasn't cycled through. It's a collective farm, which means it's an ecosystem. It's not about the information you get. It's about the information you're sending out. Does that make sense, Nathan?
Right, exactly.
It's about you're constantly in front of these people. So as the cycles through, month in, week out, week in, month out, you're getting new prospects that move into the neighborhood, people that have been there for years, but you're constantly in front of them. And so what it's doing is it's not a person looking to sell right now. It's a person asking a question, raising the hand. So we have training on how to talk. And Nathan, you've been to my script training, right?
Yep.
Have you used any of the scripting and process a little bit we talked about?
Yes, I have.
How would you feel that? And this first time, by the way, this is the first time me and Nathan have talked about this in a while. Yeah. So I don't know what he's going to say, right?
Call off guard.
Yeah. How would you say it's been working for you?
Honestly, it's good. It's really good, and it's very helpful.
A lot of times you don't know what you don't know as agents. So a lot of these people that are in the system that receive your postcards in farming, when you're doing this, it's not when they want to list. Nathan, you don't let them decide.
Right.
You want to perform some sort of value to the consumer that's raising their hand. And so things like, hey Nathan, how's it going? Nice to meet you, by the way. I noticed you're in the zip code and you had some questions. Just introduce yourself and then say, hey, and if they say, hey, I'm not that person. Oh, you must have got one of my postcards. One of your listings listed in your street. Did you have any questions about that listing? Hey, did you get a list power analysis that's by the way, part of the script. Did you get a list power analysis? And they'll go, no, I don't know what is that. Oh, we do an analysis of your listing power, wouldn't you? It's a conversation opportunity with people who live in this farm, and you're automatically getting all of these contact points every month that are further along the process that you're nurturing forever. As long as you own the zip code, it's exclusive. Nathan, do you have any questions that you might want me to ask, that you can ask me or that you want to share with the group or comments?
Yeah, no questions, but it's been interesting watching it, as people, the thing that's cool about it too is before they come into KV Core, they're requesting basically to be in your KV Core because there's like the big yellow warning that you're going to get contacted by a real estate professional. Like, so they're taking actions to get there. So they're a much warmer type of lead. But it's also fun to watch as, those emails are going out and they're put into different campaigns automatically, and seeing people sign up for listing updates, seeing people sign up for market updates. And so even though, even some of the people I've talked with, via text, because some people had messaged via text, have said, well, I'm not looking to sell, or I'm not going to be selling anytime soon. I just want to know what's going on in my neighborhood. I'm totally fine with that because they're seeing my information over and over and over again.
And what's really important for everybody here, and I keep emphasizing this, I didn't want to go back into pricing yet, but when we go into this is some stats. Nathan, it's really important for everybody within the EXP world because this has not been launched at a global level yet. Still, Nathan, by the way.
Right.
And so what I'm trying to convey to all of the EXP agents across the board is this is an opportunity for EXP agents to corner the market and brand. I wish the board of directors was here. Literally 2,000 agents can lock up all the major zip codes in a market with EXP. 1,000 agents can lock up the zip codes within EXP. You can lock up a market where that EXP is the only brand that's being sent out to all the potential homeowners within a market. And in today's market, the timing of this is perfect because that's what's needed. And we have not just this product, but we have multiple homeowner marketing opportunities that we're going to be announcing this week within EXP. So it's not just one thing. This is one component, the Nosy Neighbor app. But there's a lot of other things. So as agents, when you leave this and when you hear this recording, start spreading the news. Start talking about it. And there might have been a negative comment about Nosy, Nathan. I mean, Nathan had some questions at the beginning. You have to understand that this is farming. It's an automated process. You don't do anything. And that's a little, first, Nathan, that's a little concerning, right? You're not sure how it's going to all work because it's like getting into a Tesla.
Right. Right. And the other thing too, Brian, and you and I talked about this a lot, is that, you know, a lot of times I think, especially as agents, and especially if it's a new agent, very antsy to get business right away, and just realizing farming is not necessarily immediate business. It can happen, but it's like you've been saying the whole time, it's building that brand recognition and name recognition in that area over a period of time that will pay off as people get familiar with that name.
Exactly. And for everybody here, this works in every market. I know we have Hank here, and Nathan. Hank, I'm going to make a statement here. We've had multiple agents that were on the old Nosy program, and Hank will tell you this, that was just postcards. It didn't have all the other stuff, Nathan. It just had postcards that were EXP agents, that were other agents, and we had to sideline it. And when we did the acquisition, and they thought, oh, but then they got business still, because people don't forget your name.
Right, exactly.
And then they go, wait, I want that back. And they couldn't get it. And then when we really released it, they're going, oh my gosh, I'm so happy you brought it back. And a big chunk of agents are like, this is awesome. But at first, and I'll tell you right now, they were like, I don't know, you know? And what I want you guys to understand is, over the period of time, this is thousands. So look at this data. 19,000, this is in 1 month, 19,000 impression, 1,000 emails, engaged prospects. This is real data. And I'm not trying to sugarcoat it. That's only 2,000, because maybe those impressions data, but that's more emails went out. So, but there's also a good chunk of prospects. So we're reaching multiple thousands of opportunities that are going out. That's what you're purchasing. You're buying the exclusive to be the agent that's reaching everybody in that zip code.
Well, and Brian too, I think the other thing is just you're also buying the free time to go do the other things you need to do as an agent, you know, because it is automated, and that's a huge piece that takes a lot of time to do on your own.
It's actually impossible to do this. You cannot do Nosy.
And it's totally inconsistent when we try to do it on our own.
You can't. So what we really wanted to do is create a workflow that's automated. And now let's talk a little bit about pricing. But Hank, you want to jump in and kind of talk a little bit about anything in particular? I want to share the zip codes and how to order it and the pricing. But I also want to talk about frequently asked questions. But before we do that, I want to make sure Hank or our team doesn't have any questions, or let's open up the audience a little bit for questions as well.
Yeah, Brian, I'm not seeing any questions come in through the chat, but you know, just to your point a minute ago, I mean, you think about all of the coordination that would need to take place to get this all done by a single agent, and the skill set you'd need to bring to you know, be on Google and get a landing page set up, and you know, have a coordinated email campaign go out, and all these pieces working together. It's a lot. And Nathan, to your point, like, man, hopefully, you know, the design is to just free you up to do what you do best and have those human conversations. And, you know, when your face is in front of those potential people who want to list with you, they know who you are, and that conversation just happens, right?
Right. And the other thing too is, you know, it does free you up, and it does it's just keeping your brand in front of them over a long period of time. And so, you know, the busier you get, the more inconsistent you get if you're trying to do that stuff on your own. And so it's knowing that it's there and it's running and it's happening. It, like you just said, it frees you up to do, you know, frees us up to do what we do best in those warm, personal conversations.
And it's not just one little area. So it's like a little bit pocket in this zip code, a little pocket in this zip code, a little pocket in this zip code. And the other thing that, Nathan, that you pointed out is when they move into KV Core automatically, and the listing alerts get set up. Again, he doesn't have to do that. The market reports get set up. You're nurturing that warmer lead automatically with events that happen, and now they're getting a listing alert from you. So you're 85% more likely to get that listing because you're reaching out with them about data they want, and it's his data, and he can nurture that collectively. So he's just focusing on those. He's not focusing on the 19,000. He's focusing on a segment. So he can send a mass email out once a month going, happy July. I'm going to send a listing report out to the most recent listings in your market. And he can mass send that out to everybody in his Nosy zip code. You can organize a wine tasting event in your Nosy zip code. You can create other ways to engage this captive audience within your zip code of target people. And this can be automated. He doesn't have to manage the farm. He just manages the prospect with events.
Right.
And this is really effective. But again, the hard part's done for you. Easy part is easy to do for him because it's all tied into KV Core. Now, I want to stress this to everybody. This is locking down it in your brand. You should tell your downlines about this, right, Nathan? Get the downline.
Yeah, when I was the only one from our team that was on that original call, and 4 of us are all on it now. So
I can't stress this enough. And there's a little misconceptions in the beginning of things. People have misconceptions about farming. I want to encourage that this needs to spread like a virus within EXP. And I'm passionate about it. And let's talk a little about pricing. Now, the pricing is $7.49 per month per zip code. If you buy more than one zip code, you can have bulk pricing. And what you do to order it is you go to nosyneighbor.com or within your EXP dashboard, and Hank's got the slides up. He's going to show that in a second. We'll show you how to order it. Now, when you download the app, you're just putting in your personal information and the logo and some compliancy